Hit it.
It's Friday, July 23rd, 2021, episode 141. I'm Patrick Ceresna.
And I'm Kevin Muir. This week we welcome to the show Alfonso Peccatiello, head of investments for a large investment bank and author of The Macro Compass. We have a terrific discussion about the macro environment and why, even though the sovereign is a currency issuer and not a user, there are still some major disinflationary tendencies that are difficult to overcome. Then, in Talking Charts with Patrick, queen of the markers, we learn what's on his technical canvas these days.
This week in trading history, we go back to the creation of the Bretton Woods system, and we end with the segments of No Stupid Questions. And, well, Kev, I'm looking forward to the no Skin in the Game segment. And, folks, we might even drink some beers along the way, so stick around. We got a great show. Lena, hop on here. What beer are we drinking this week?
This week we are drinking Junction Craft Brewery's Halftime Hazy Session IPA.
Actually, that's really nice.
Made in collaboration with the Toronto Aras rugby team, the Session Hazy IPA is brewed with Eldorado, Mosaic, and Citra hops. It is juicy, hazy, fruity, and crushable AF. Perfect for a game day.
It is interesting that it is an IPA, and it's only 4.2%. It's like a light beer.
Yeah, I actually...
That's rare, because a lot of IPAs
when I
will
heard
run
juicy, I thought it was going to be disgusting, and then I saw IPA, and I was sure it was going to be disgusting. It's actually pretty good.
It's not.
It's actually really good.
Yeah, it's nice. I am going to enjoy it. So let's do this. All right.
Let me do the disclaimer. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much Huddle may include the Capi Costa Rica COVIDectomy. I don't even know how to say that. The sour slurs, which I've already got by the sounds of it, and feeling raw on your alpha. How would you say that, Lena? How do I say that?
Feeling raw in your alpha?
No.
What are you talking about? Which part?
COVIDectomy.
COVIDectomy? COVIDectomy?
Oh, okay, whatever.
We're not going to ask Patrick.
Don't ask me.
Okay, on to the interview. Okay, it's our pleasure to welcome to the show Alfonso, and I'm going to give this name, I'm going to butcher it, Peccatiello. Have I got that right, Alfonso?
Of course not, Kevin, but it's fair enough. I mean, that's your best attempt so far.
Alfonso is the head of investments for a large European bank and the author of the Macro Compass newsletter. And before we start, being the head of investments for a large European bank, he has compliance issues. So, Alfonso, why don't you just kind of get these things out of the way and give us your disclaimer?
Yes, sure. So I am head of investments for a European bank, but in this podcast, I'm going to speak on behalf of myself and myself only. So everything I say is my own opinion. It will not represent my employer's opinion. Done with the boring part.
Yeah, I understand. As anyone in this industry knows, and especially with you guys in Europe with your MiFID, it's even worse for a lot of your compliance issues. So you're actually, I feel like, getting away easily that way. So, Alfonso, it's a pleasure having you on the show. I've been looking forward to this because a lot of people are disinflationists and kind of see prices headed down, but they do so from a compass of that the debt has to be repaid and kind of they don't understand how the actual system, the financial system works. And I've been, fascinated by your interchanges on Twitter where you've gone through and explained to people how, a modern fiat money system works, and yet you still come to the kind of more disinflationary camp. So we're going to have a great discussion because I've rarely seen someone who understands that and yet still comes to the disinflationary conclusion. But before we do that, I'd love to learn more about yourself, your accent, and if your accent doesn't give it away, your name definitely does. You're grew up in Italy. How does a fellow from the south of Italy end up being the head of investments for a large European bank?
Well, I think I owe part of this to my family. So my mother is a treasurer for a small Italian bank. So since I was 15, I'm used to look at BTP future graphs. So this is the graph of Italian government bond futures. And so I got basically passionate about the topic since I was a kid, right? Okay. So you start trying to dig out what the graph is actually about. It's just the charts moving, and you don't understand anything about that. So you probably want to find out, right?
Right. So wait,
And
can I interrupt and just right off the bat? You say your mother was a treasurer for an Italian bank. I don't know, how your age, but were you grew up in an environment of only the euro, or did you have do you remember the lira?
I'm not old enough to remember No, I'm kidding. I am old enough to remember the lira, but no, I didn't trade the lira. If that is the question,
No,
Kevin.
you
How
didn't
old are
trade
you?
it. No, I did. But in terms of when you were growing up and you were seeing your mom with these different things, was that in the era of the European Union of already taken and we were just trading the euro? Is what I was asking.
So let me see. I'm now 30 years old. So that's about 15 years ago, 2006. So
Yeah,
must
it's
be the
all
euro.
euro for you, right? Like
Yeah.
so you never experienced. So you've grown up solely in an environment of the euro, and you grow up with your mother seeing these things. And how does that kind of inspire you? What is it that it intrigues you about that?
Well, it's just me waiting for my pasta at lunchtime, and my, seeing these charts on the table and asking her, "What is this?" And she goes like, "Oh, this is the BTP future." And I'm like, "Yes, this means nothing. So what is that?" And so she has to try to explain that. And it's a lot of new things, right? I think for a kid, for a naturally curious kid, it drives you to try and find out what the hell is that after she's gone back to work.
Right. And so you go to, you're kind of stoked by this, and you go to school thinking I'm going to become a portfolio manager and a trader. Is this what you, or do you go to school doing something else?
You go to school and you're like, okay, so all these things are impacting the price of bonds. What the hell is a bond in the first place? So
Right.
you try to find it out, and also to find out how the economy works. And then you end up at university where you take macroeconomics course after high school, right? So you take a macroeconomics bachelor, and then these guys start to teach you all about loanable funds from a bank and all that crap and wrong banking theory system. But they also teach you some proper stuff about economics. So you grow up with a distorted view of how the monetary system works, but at least an understanding of how the economic system works as a whole. And then you're like, okay, what am I going to do with it? Because I still like all these charts about, markets and financial instruments. So then you go for a master's degree, which is more in quantitative finance, where there is a crazy mathematician professor drawing stuff on a blackboard to try and explain to you the Black-Scholes equation and all the theory and the stochastic mathematics that comes before that. You understand half of it, but they still think you're smart, so they give you a degree. And then you end up in Germany, where I finished my master degree. And the German experience was very interesting because you also the teaching system is completely different from Italy. It's much less theory and much more application. So that brings you closer to reality, to actually the financial instruments you're supposed to price and trade. And it was, I think, a pretty interesting experience.
Do you think that was just your school, or do you think that's a cultural difference in terms of Germans versus Italians?
Both. I think it's both. So when you go into this university where I went, winning a scholarship. So this was a private university, pretty known in Germany, which obviously I couldn't afford anywhere close to that. But by winning a scholarship, I could actually go there. You enter there and you see it's all basically applied, as in they want you to teach stuff that you can apply to a job, rather than some fancy stochastic equation you can solve without any applicable results out of that. So I think it's also the cultural difference of the German education being more skewed towards applicability of notions, and having had a theoretical background and then a year of this more applied stuff. I think it's a pretty decent setup.
Right, and then so out of there you get yourself a job, and what does that job entail at first? Are you hired for a quantitative background, or is it more on the investment side?
It's a mix, I think. So the first job was in Amsterdam for this European bank. And, it was basically about managing a portfolio and analyzing the issuers within this portfolio. So what is the credit worthiness of a certain country rather than another. But obviously the quantitative skills also come in handy when you have to program stuff and handle data, for example. So I would always suggest to somebody to try to get a broad education. And nowadays it has to entail not only you understanding macro, but also you being able to, code a little bit and being able to digest a couple of equations here and there.
And what was your background in terms of being able to code? Was that something you only learned in your master's degree, or had it always interested you, and you were kind of the new generation of traders that are a lot more than just Excel kind of knowledgeable and actually can do some Python or other things like that?
No, I started from pretty basics actually, and it's still relatively basic. And it was all about Excel and Visual Basic and all that stuff. So at the end of the day, in Italy, we did some of this quantitative stuff also in programming. So there, it's where I started to understand how that works.
Right.
It fascinated me a bit, so I developed a little bit by myself. And then in Germany, I found out that a lot of it required coding because these guys want to have applicable outputs of your university studies. So of course, being able to program some of that was important for them. So you nail a little bit your programming skills at university. But to be honest, most of what I do now is broad macro. So all these quantitative skills they come in handy when it's necessary, but they do not represent a large portion of what I do now.
Right. Now, having said that, though, being able to talk that language and be able to go and get someone else to do it and to be able to understand those graphs and that quantitative stuff is obviously very important, right?
Yes, I would say so. A bit of understanding of basic statistics, mathematics, econometrics, a bit of programming. I think it really helps you to, first of all, call the crap in all these spurious correlations you see. Yeah. So, people drawing a couple of lines on a chart and they say, oh, look, there's a correlation. Yes, sure. And, sometimes it also makes you look fancy. You know what a Granger causality test is. You can people think you're smart, if it helps. I'm just kidding.
So one of the things that I love about you, Alfonso, is that you're willing to throw kind of put light onto some of these things that people assume are the way it works, and you're like, no, that's not actually how it works. And I've watched you interact with people and kind of push back on some of the let's just say, how would you describe it? The kind of things that everyone know are true, but there really aren't, and those are the ones that really get you into trouble. And you kind of touched on it briefly when you said something to the effect that you went to school and you learned some economics and they taught you a lot of crap. How did you come about realizing that maybe some of the old the way that we think about the economics is incorrect, and to start applying a more realistic kind of way about how the economy actually works?
It's a great question, Kevin. I would say, again, curiosity. So when somebody teaches you a theory, there are two ways to approach that. One is to just take it for granted and say, okay, that's how it works, because banks take deposits and they lend them out. Yes, sure. And the other one is to think whether that is true or there might be an alternative explanation to how things work, because maybe in your empirical observations, you have realized that this is probably now not how it works. But in order to try and dismantle a thesis, you need to be curious enough to do your homework and go check what other people that don't agree with that thesis are, postulating as an alternative thesis. And effectively, that's what I did. I, started digging into papers and reading books of people that were postulating another theory for how the banking system works, but actually how the whole monetary system works. And, you start with your own doubts, and then you read and you cement basically a new theory, which is not actually new. It is just how common sense would make you understand the monetary system.
Do you remember the first time you were like, whoa, goes against everything that I've learned?
Yes. Cullen Roche,
yeah, okay.
Which I think is a great guy.
We had him on the show. He's a great guy. Yeah.
Great guy. So I actually, my girlfriend, who was a mathematician a few years ago, started asking me questions about money. So they were like basic questions, like, okay, so we now make a bank deposit, or not actually bank transfer, from account A to account B. But how are these banks actually moving money? I mean, what is money? Are we talking digits? Is it backed by something? Well, what's happening here? I mean, we make a bank transfer, and then what? I mean, how can I go to the ATM and withdraw cash? I mean, how can a bank always be able to serve that? Those are basic questions, right? For somebody for economics. And then you start mumbling answers. And as you mumble, you're like, okay. So last time they taught me this was a few years ago in university. Haven't really thought about that since, but okay, let's see what I remember. So I remember that, and that. And then you give the answer. And while you actually spell it out, it just sounds wrong as you give the answer. It doesn't square. And then you're like, okay, maybe I should do some research on this.
And so you grabbed on the internet, you went and found Cullen, and he opened your eyes to kind of, that was the first point where you realized that a lot of these ways that people think about the financial system isn't quite right.
Yeah, it was Cullen first, but also was myself thinking like, okay, so let's assume I want to open up a bank tomorrow. And I'm going to raise capital. Sure, I'm going to have some equity, and I'm going to go and do all the regulatory stuff required to open a bank. Okay, cool. Now I have a bank. So I want to make my first loan. And so what am I going to do? Am I going to wait for somebody to come in and give me deposits and put them in a box? So stack the cash and put them in a box, and then say to my loan officer, all right, so this is 80% of what we got. You can lend this one out. The rest we'll have to keep them. Is this credible? I mean, is this how it really works? So when I walk into a loan officer, place, and then I ask him for a loan, is he going to call up somebody and ask if they have enough deposits or enough reserves? Or I don't think they do that. So I started asking myself these questions basically, and then Cullen's work was, of course, something I started to study, and together with him, many other inputs. I think there's so much free knowledge online today. It's all about curiosity, right?
Right. Okay, so let's talk about, though, the idea that banks take deposits and then lend them out, because I think from there, once you realize that isn't the way it actually works, there's a lot of different things that fall into place in terms of how we think inflation will work and how we think the economy will work. Why don't you walk us through exactly why you think that this is kind of, or sorry, why didn't you explain to me, if I'm correct, that is one of the biggest fallacies out there? And does that then create a whole different way of looking at how the economy and markets work?
Yeah. So let's start maybe from debunking this one, or at least proposing my thesis, which is not mine really. It's widespread. I hope it's widespread by now out there, right, in the fact that banks don't use deposits to make loans. Banks create new deposits every time they lend out. So you'll have to start thinking the other way around. A loan comes first. Once a loan is done, a new deposit has to be deposited somewhere into the banking system. It's just an accounting identity. There is nothing, in my opinion, which is even debatable about this idea. We can use chart 11 to
right.
To
for those who don't know, we have a chart book that Alfonso has brought along with us and is so kindly done. And chart 11, I believe that's from the famous Bank of England paper, is it not?
Yeah, it is. But the fun part about this is that this comes from the Bank of England. So we're talking about the central bank together with the Bundesbank, together with Norges Bank, if I'm not mistaken, Bank of New Zealand. Some central banks out there are, without a problem, postulating that banks don't need deposits to lend. They actually create deposits when they lend. And by that, they're basically admitting that by far, the lion's share of new, as I call it, outside money creation or inflationary form of money creation is in the hands of commercial banks, not central banks. But we can talk about that later. Okay. For now, let's talk about what happens when a loan is made, right? So this picture, if you take the center part of it, where commercial banks are depicted, the left side shows the commercial bank balance sheet before loans are made. And guys, those are stylized balance sheets, so don't be too picky about this. It's really a stylized example. So on the left side, you'll have the balance sheet of a commercial bank before the loan is made, and on the right side after the loan is made, right?
Okay.
So you'll see that the commercial bank balance sheet on the liability side has deposits. We'll make it simple, only retail deposits. And then on the asset side, it has, some reserves, and maybe it has some assets, it has some cash in the vaults, it has whatever, right? Now, this is before the loan is made, and now after the loan is made. So how that would work in reality is that the bank would produce a new asset. So you, Kevin, would like to buy a car, right? So you walk into the bank and you're like, okay, I would like a loan to buy that car. And the bank checks your credit worthiness. The bank checks whether the return on equity on your loan makes sense for them to produce a new loan. And the bank checks whether you're able to pay back this loan at the end of the day, right? Against your cash flows as a private person, Kevin. And then they say, well, I like this guy. He's Canadian. He's probably nice. He's gonna pay back. So they are like, okay, go buy a new car, and they credit your account, right? So you all of a sudden will find money parked in your bank account, right? So they credit your bank account, Kevin, and basically by doing that, they have created also a new loan on the asset side of their bank balance sheet. There's a new loan which says credit for Kevin that buys a car, right? Loan for credit, for Kevin to buy a car. Now, Kevin has this money sitting in his bank account, right? And he will buy a car. So Kevin goes to Alfonso, and I'm going to sell you a crap car, but you still will pay money for that.
It's not going to run very well, but it is going to be beautiful to look at.
Sure, of course. And then you say, okay, here is your money, which of course is going to be a bank transfer, not a cash transfer. But okay, so you'll say, I will debit, you instruct your bank to debit your account and to credit my account, right? That's what's going to happen. So after the transaction, you will have a car, right? And the bank will have an asset. Your bank will have an asset, right? A loan. And then the entire banking system will have also a deposit, an additional deposit, because you have transferred money to me. So I, as Alfonso, will need to deposit this money overnight somewhere, right? So the whole banking system will have created a new asset, which is the loan that now you owe the bank for because you have bought my car with a loan, right? And the banking system will also now have a new deposit, right? A new deposit, which is the money that I received in exchange for the car. And this money needs to be deposited somewhere at the end of the day, right? And people are like, yeah, but you can spend your money. Yes, sure I can. I spend my money, and then what happens to the next guy where I bought the product for? He needs to deposit this money somewhere overnight into the banking system. So the overall stylized commercial bank balance sheet will have increased its assets and will have increased at the same time its liabilities.
Now, and so one of the things that people probably need to understand is that the vast majority of actual credit creation is done by the private sector in this fashion that you just I think I remember hearing you actually had a number for this. Is it 80%?
Yes, no, it's larger than that. 97% of, let's say, the inflationary form of money and the credit creation is basically done by the commercial banking sector. Right. So why do I say that this is new money being created? Well, you sold me a car, and you didn't have the money for that before, right? You went for a loan, right? And the bank created a loan, and now you bought the car, and all of a sudden I have some money deposited in my bank account in exchange for the car. This money literally did not exist before. So with a stroke of a pen, by an accounting identity, the commercial banking sector has increased its balance sheet by creating a new loan, literally out of nowhere. All right. And this newly created loan has been used to buy a car. And I, that sold you that car, now have an additional money that I didn't have before. And I deposit this back to the commercial banking sector. And therefore the asset liability identity remains. But the balance sheet has increased out of the thin air. We didn't need any initial deposit to create this new loan, Kevin. You just went to the bank, asked for a loan, they made a loan, and they have to match it on the liability side. And the identity item to match that on the liability side is the new deposit that someone that sold you that product for, the car in this case, will need to park overnight back into the banking system.
Right. Okay, so I think that most people would agree with that. And I think that most people would also agree that the central bank setting interest rates tried to influence the private sector credit creation, whether that be to encourage it or discourage it at different parts of the economic cycle. Can we agree on that?
Yes, that's what the central bank would try to do. That's
right.
Correct.
They try to do that. Now, I guess the problem a lot of people have is that once we get to a point where the central bank has put rates down to zero, and we get to the point where they cannot lower rates anymore to encourage more private sector credit creation, we get this thing called quantitative easing, where the central bank goes out and buys bonds and puts money. We'll debate about whether it is, but the kind of the theory is that they stick all this money on the bank's balance sheets, the commercial bank's balance sheets, and we are going to get basically inflation. And if we think back to 2009 to 2011, when the quantitative easing was first coming, we had all sorts of warnings from very famous, influential economists about how Bernanke was playing with fire and he was going to create this inflation. The dollar was going to go to zero, blah, 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 blah. And it ended up being that was not the case. Can you explain to people what those famous economists got wrong?
Yeah. So let's start first from debunking the common knowledge that lowering interest rates would immediately straight away have a correlation, one, to banks being willing to lend more and actually expanding their loan book, right? Why do I want to debunk that correlation? Now, again, if a commercial bank wants to lend money, they are constrained by a couple of things, not by the existence of deposits, very, very, very little by their reserves that they own. They are very constrained by two things. One is the existence and the abundance of capital they have to put against that loan. And the second one is the return on equity they would make when they lend the money out against the risk they take by lending the money out. Those are the two most important drivers that a commercial bank would look at before lending. Now, you said central banks lower interest rates. This is supposed to spur credit creation in the private sector, right? I mean, it's not you thinking that. Maybe you do think that as well, but it's common knowledge, right, to assume that.
Right. Well, that is what the market believes. That's correct.
Yes, that is correct. Now you take a commercial bank in Japan or in Europe, whatever, right? So they'll have to make a new loan decision today, and they therefore would look at the capital that have attached to loans and the return on equity they make on these loans against the risk they take. Let's have a look at this for a second. So the capital they'll have to attach against the loan is still pretty large. The regulation hasn't eased meaningfully since 2007. It has actually become tighter after the great financial crisis, right? So the amount of capital that you need to put against the loan has not gone down, meaningfully down. So regulation is not helping them on a net basis since the great financial crisis. Now, what is the return that they make from a loan yield today? Well, loan yields are the lowest ever on record. So the absolute nominal return, nominal compensation they would have from lending money to somebody is as low as it can be against capital required to back that loan, which is not anything lower than it was compared to 15, 20 years ago, right? Where loan yields were much higher.
Right.
So their return on equity, looking at the nominal yields on the loan and the capital they'll have to attach against that loan, is pretty bad. Would you agree with me?
Yeah, for sure.
All right, cool. So under which basis lowering interest rate? And I forgot the last part, the most important part. When the return on equity is pretty bad, perhaps the credit worthiness of the private sector that is borrowing this money is going up to offset that, right? So I have less of a return, but I'm also taking less of a risk. That would at least encourage me to take some more loans on my balance sheet as a commercial bank. Well, the leverage of the private sector is as high as it has ever been in the US, for example, or in Europe as well. So in the US, private sector debt as a percentage of cash flows or as a percentage of GDP is 165% today, 165. So we're talking about the private sector, which is already over-leveraged, whose, basic credit worthiness metrics are not great, just to use an euphemism, are really not great. And we are looking at this poor credit worthiness against an already pretty low return on equity, which is driven by tight regulation and low loan yields. So banks are definitely not willing to lend at these conditions.
So, and if we think this through, you mentioned the fact that 97% of the inflationary money is created by these commercial banks. So the reality is that everyone sits there and stomps their feet about quantitative easing and how this is going to cause all this inflation. But but we're not actually seeing any actual, I guess, high-powered money credit creation because of all these reasons that you just mentioned. Another way that I like to talk about this, Alfonso, is I like to say when quantitative easing happens, when the Federal Bank, the Federal Reserve New York branch buys $1 billion of bonds from J.P. Morgan. Does that make J.P. Morgan all of a sudden any more likely to go and make a loan? I would argue it does nothing to their willingness or desire to make loans, and that banks are not reserve constrained. And so therefore, the way that we've been thinking about this, that quantitative easing can affect this, is all wrong. Now, if that is the case, what do you think quantitative easing actually does in terms of the effects of the real economy and, more importantly, the financial economy?
So I think you're perfectly right, Kevin, in assuming that if JP Morgan would have its asset side of the balance sheet being forcefully swapped by the central bank into a zero duration asset, being reserves from the existing bonds they had because they had to sell them to the Federal Reserve into a QE program, that makes them zero more likely to increase their loan book, or at least the correlation between this QE activity and the willingness of JP Morgan to expand their loan book is not negative, not positive, it is zero. Okay. So I agree with you. That has nothing to do with JP Morgan being able to or willing to lend and create new inflationary form of money because QE is existing. So what is QE actually doing? I think before we go there, I would like to show Japan, the Japanese example, which is, I think, pretty telling. In one chart number 10, this is a chart that shows base money, broad money, and bank loans in Japan between 1999 and 2007. So this is the era of, the initial QE boosts from Japan around 2000. You can see in here that the base money went up, and they're all indexed at 100 in January 1999 in this chart. So base money doubled between 1999 and 2005. So what this means is that the amount of reserves into the banking system doubled in 5 or 6 years, right? So that's the red line. Now, would you please help me and look at the blue line in this? It's bank loans. So from 100, bank loans went to 75. So the private sector effectively decided to deleverage. So banks took their banking books, their loan books, and they shrunk them. They didn't even keep them flat. They literally destroyed existing credit by not renewing something which was rolling off of their loan book every year. And the private sector, for sure, was not there to ask for money. Otherwise, the demand for credit would have pushed commercial banks to probably at least keep their loan book flat. But what we saw happening is that the reserves went through the roof. They actually doubled. And bank loans actually shrunk by 25% over the same period.
Okay.
Now, I think that's pretty telling, right? So you can see that the correlation between the amount of reserves, monetary base into the system, and bank loans, well, in this chart is even negative, all right? So it seems visually negative. So as monetary base goes up, bank loans go down. I won't go as far as to say that it is negative, but I would for sure go as far as to say that the correlation is absolutely zero.
Okay, I would agree with that. Yeah.
Then to answer your question, why would QE even be a thing in the first place, right? I mean, why would they be doing that? Well, I think that the QE part has to be seen in a much broader spectrum, right? So we'll have to talk a little bit about how the whole monetary system works and how we try to achieve growth.
Okay, well, let's do it. Take us on the journey.
All right, I'll try. So to do that, I'll have to start talking about what drives long-term structural growth first. So let's start from an economy in which you don't want to expand credit. You just want to use your resources to grow at potential, right? You just want to achieve your potential growth without borrowing or without using any tricks. Let me call them tricks for now. All right.
Okay.
So if you want to do that, you'll have to look at basically two elements to make it very simplistic. And one of it is the amount of people that actively contribute to the economic cycle. So that's the labor supply. And you'll have to see how this labor supply grows or shrinks over time. So do I have more people working next year or less people working next year? It's a very simple question, right? And then the second question that you'll have to answer is, how productive is my labor force? And how are these guys able to, what is the output they're able to produce during their lifetime, right? So those are the two most important drivers of long-term trend growth. Now, there might be others, but this one explains a very large proportion of this structural potential growth of an economy. So I just went there and I plotted for you in chart 1 the labor supply growth. So you basically are looking at a pie here, and you are looking at whether this pie is going to expand or is going to shrink on a structural basis. And you'll have two elements to make it bigger or smaller. One is labor supply growth. The other one is productivity of this labor supply. Again, I'm probably simplifying, but I'm doing this to pass a broader message. And you look at these labor supply estimates, Kevin, and they look pretty horrible.
And that's largely due to the demographic problem.
That is correct, right? I mean, if people have to retire because at a certain age they have to get out of the labor force, then you normally would have kids that enter the labor force and replace this retirement effect. But as the birth rates have dropped dramatically since the 70s, of course, the new cohort of people being able to replace the labor force retiring is not enough. So the effect you have is you have a negative year-on-year labor supply growth in most developed markets. So I put a red circle there. And I would like to point at everybody telling me that America is different. And no, America is not different. America is just lagging other, countries or geographies like Japan or Western Europe by about 8 to 15 years. But the trend is exactly the same. So America in this chart is the light blue line, and year-on-year labor supply growth in America is estimated to be mildly negative for the next 50 years. So take a second, stop there and think that the American labor force is not going to expand year on year, is going to stay flat at best or to shrink.
Okay, I'm with you.
Cool. Then you'll have to look at productivity, for which I don't have a chart, but I can only tell you that the productivity, the output per worker we used to have during industrial ages like the 70s and labor intensive ages like the 40s or the 70s is nowhere to be seen today, right? So that productivity has dropped to levels that are still positive. So we produce output per hours we work, but the increase year on year in these productivity levels is not mesmerizing all over the world. So we're talking about a productivity which is about probably 1% year on year positive. It grows at 1% year on year. Now, if you have labor supply negative in America and then you have productivity at about 1% positive, you end up at potential growth levels which are pretty politically unacceptable, as I would call that. So if I would tell you that America is able to grow at about 0.5% to 1% in real terms, year-on-year GDP real growth a year, 1% or 0.5%, you would probably not be that happy about it, right? Neither as a politician nor as the broad society, I would say.
Okay, I'm with you so far.
Cool. Then what do you do? I mean, what do you do? We don't like, we are humans and we have a political system that is based on having everything now, everything immediately. We can't wait. We can't revert to the mean. We want to have all the benefits today, right? So what do we do then? Well, we expand credit. We construct a monetary system since the 70s that effectively allows credit expansion backed by about nothing, and also credit contraction at your will. So your credit creation or destruction is basically completely flexible, right? But guess what? Instead of destroying credit, we like to create credit, because every time we create credit, as you can see in chart 2, when credit flow goes up, and this is a chart from Deutsche Bank for, I think it's 15 years old chart, but it shows that in every financial crisis, what happened is that we started pumping credit, and I'm talking about not bank reserves, I'm talking about credit that flows to the real economy. So mostly bank loans and fiscal spending under certain circumstances that I'm going to cover later. This credit flow to the real economy pushes GDP up again. And if you would run a causality test, credit flow would lead GDP and not vice versa. So what I'm trying to say is you have a very poor structural growth. You don't like it, so you expand credit, right? So because the monetary system allows you to do that basically indefinitely, because there is no hard asset which is immediately backing your credit expansion, right? So guess what? We end up doing that. Now, at some point, there is a problem. And the problem is that if the system becomes over-leveraged, the private sector, and I want to stress this out, not the public sector, but the private sector might have problems servicing this amount of debt.
Okay.
Right? So if you are a household or you are a corporate, you are not a currency issuer, you are a currency user. This is a material difference. The household balance sheet requires you to have cash flows to service your debt. So when your coupon comes due or your notional comes due, it's all about your ability to refinance or your ability to service your coupons with real cash flows. You cannot issue your currency. You don't have that power. You have to pay your debt with real cash flows, with your earnings, basically. Now, if you become over leveraged, one way to make sure that you can keep up with these coupons is either that your earning capacity has gone up massively, so the economy is effectively becoming more productive, there is a higher trend growth, etc., or you can simply lower your interest rates. Right? If you lower your interest rates, then it's much simpler to service your debt. Now, I want to stress out, we are talking about real interest rates here. This is the most important metric rather than nominal interest rates, because as a borrower, but also as a creditor, your purchasing power and your ability to refinance is also needs to be adjusted by inflation. So if I am somebody that has borrowed, a household that has borrowed a large amount of money, and I pay a nominal interest rate of 1%, let's assume for a second, of 1% on my loan, but inflation is 3% year on year, then the real debt burden effectively shrinks for me year after year, because 3% inflation is eating away in real terms my debt burden, right? While 1% nominal interest rate I need to pay remains there, but in real terms I'm paying minus 2%. Would you agree with me, Kevin?
I'm with you the whole way, Alfonso.
Very true. So now if I am an asset owner and I get 1% as a creditor, and then inflation is 3%, I get the other side of the treatment. So my purchasing power is shrinking. So quantitative easing helps in that sense, because the central bank, in the process of buying bonds, has to bid up the price of these bonds. And when it does, it also naturally tends to reduce yields. As we bid up the price of bonds, the dealers will have to sell these bonds to the central bank. And if they know that there is a relatively price insensitive buyer there, then also, price of these bonds will naturally or normally tend to go up. Nominal yields will go down. And as long as you can engineer some sort of stable inflation, let's call it low but stable inflation, your real interest rates will drop as the result of nominal yields dropping and inflation expectations staying relatively constant. So the role of quantitative easing is to make the system actually stay afloat, is to accommodate the credit creation system with which we overlay cyclical growth over very poor structural growth. This is the main reason why quantitative easing exists. It accommodates the most important driver of, let's call it, wealth illusion, which is basically what's going on. We overlay cyclical growth on poor structural growth, and we increase the net present value of our assets by lowering real interest rates and therefore future real discounting factors. That's the main reason why QE exists.
Okay, so it's to keep this whole game afloat, and you're stressing that it's real interest rates that we should be watching that is the most important part of that equation.
Yes.
Okay, now we haven't talked about fiscal deficits yet. I would love you to bring that in. You mentioned briefly currency users versus currency issuers. There's no doubt that what this COVID has brought about is that the market has finally woken up and realized that the two are much different. And we've seen the currency issuers creating money like we've never seen probably in 40 or 50 years. And I was wondering how that plays into your thinking about how the economy and markets work.
Yeah. So the other entity which is able to effectively expand new inflationary form of money through the real economy is the government, under certain circumstances. So the government's balance sheet doesn't work like a household balance sheet. And this is not the concept which is fully understood. I mean, we are toying with the concept, but I still hear discussions now about the next infrastructure plan and how America is going to pay for it. I still hear European, especially Northern European countries that have this austerity well built in their DNA, talk about fiscal rules and fiscal austerity is a strong word, but fiscal discipline to have to be reinstated since 2022, since 2023, actually. The European Commission came out with a statement that, fiscal integrity needs to be restored after 2023 already. So we're going back to the same old pattern where the government needs to raise, needs to cover these expenditures from somewhere, which is actually what the government can do if they wish to do. But the government in the first place is basically the issuer of the currency and not the user of the currency. So if the government would decide to fund some of those expenses, they could simply decide to issue new bonds if they wanted to. And then they could try to find a buyer for it. So the buyer could be the private sector, or the buyer could be their arm, which in America, their monetary system arm, which in America is the Federal Reserve. But the main point here is that the government effectively can decide to spend or to transfer new inflationary form of money through the private sector. And, it doesn't need to repay any of the debt, because when it comes due, it can again repeat the exercise without having any cash flows to service this debt. There is no need for the government to have cash flows to service this debt, as long as there is trust in the currency that is being issued to preserve somehow the purchasing power and to continue to act as a stable mean of payments. As long as this is true, the government doesn't need any, form of cash flows or, and effectively, it doesn't work like a household balance sheet. It's completely different.
So, Alfonso, like a lot of people say, when you start telling them this, they push back and they say, no. If you do that, you're going to create inflation, which is exactly what the MMT folks will say. The government can spend up until the point that they create inflation, and it's inflation that is the real constraint, as opposed to, other perceived financial kind of limits.
Yes. So let me elaborate on this point. So government is effectively constrained, as I said before, in this exercise by the broad opinion and the public to accept the currency being issued as a mean of payment, as a mean to basically preserve somehow the purchasing power over time. All right? This is more or less the constraint in this case. But the concept that continued fiscal spending would, without any doubt, lead to runaway inflation actually misses a very important side of the coin, which is the private sector. So if the private sector is actually asking for a loan to the commercial bank and there is healthy credit demand, and the commercial banking sector meets that demand, it means that the private sector would have made up their mind that borrowing a certain amount of money and spending it into some productive investment outlet would generate for them a decent return over time, right? So there's healthy appetite for credit, and therefore the credit demand is there. Banks maybe want to match that. They create new money into existence. This money is taken by the private sector to do something productive with it. Now that's the healthy credit creation. Fiscal spending is, in my opinion, almost never productive source of new inflationary form of money creation. And why is that? It's because the private sector didn't ask for it. The private sector just, it's the recipient.
Can I jump in there, Alfonso?
Yeah, sure.
But what if the private sector has borrowed too much in the past and is unable to do any more and doesn't want to create any more credit?
Your question is why?
Well, no, but you're saying that it's always unhealthy, or you do not view government credit creation or fiscal credit creation is as healthy as private sector credit creation. And
well, both. Kevin, both of them are not necessarily healthy or unhealthy. I'm just saying that if I need to rank them, then I would assume that commercial banks extending credit out of credit demand coming from the credit sector, that would be a healthier form, ceteris paribus, compared to the fiscal deficit arm. And why is that? It's because for a bank to make a loan, you must have somebody asking for a loan first. It's very simple, right? I mean, you need the private sector to want to borrow.
But
if you
sorry, go ahead, keep going. I didn't mean to interrupt.
No, it's okay. But then the fiscal spending would effectively slosh people with newly created potential inflationary form of money, right? But the private sector might decide to use some of this money to pay back existing debt, or to just keep it idle on a bank account and not spend it. So when people are saying that printing fiscal deficits and having maybe the monetary authority accommodating the process by swapping and making room effectively for these new bonds in forcefully swapping commercial banks' asset side from bonds to zero duration assets to more zero duration assets and less bonds, which is what QE does. It's just an asset swap, right? They make room for this to happen more easily. But this doesn't mean that the private sector will go out and want to spend this money. It could easily mean that the private sector take this money and pays down existing debt, for example, or just refuses to spend it. It just wants to save it, for example. So taking only the fiscal side of it, the government side of it, without looking at what the private sector is trying to tell you, I think is pretty misleading.
Okay, I'll buy that it would be all else being equal, that it would be better if the private sector was demanding credit, because it would be more of a healthy kind of economy. But one of the things that I kind of jumps up to me is Europe as a perfect example. They're running deficits that are too tight, meaning the fiscal side of their equation, or at least in my opinion, the fiscal side of the equation is too tight, and therefore there's not as much money in the system, and it almost becomes a self-fulfilling kind of negative feedback loop, meaning that the government is taxing too much, which is another way of thinking about it. Instead of the government spending too little, you could say the government's taxing too much, and therefore the private sector is starved of money, and is basically in a situation where when they do get some money, they just go pay it down, because we've entered into this negative feedback loop of realistically let's just say a deflationary mindset, the old Richard Koo balance sheet recession.
Yeah, I think it's the right way to look at it. You can also think of the government taxing too much rather than spending too little, or vice versa. And, but the most important thing, Kevin, is that you do understand the interaction between the private sector and the public sector. People here are getting absolutely fanatic about fiscal spending is going to be permanent, is going to be ever increasing, is never going to stop. We're never going to have a fiscal cliff, and therefore inflation is here to come. This is the thesis, right? Or what I'm hearing a lot.
Well, that was definitely 3 months ago for sure. That was it. Definitely was kind of the thinking was that the government was going to keep spending forever, and that we were going to get runaway inflation, and that the world had changed.
Yeah. Okay. Now to that, I would like to point a couple of stuff. So the first one you see is in chart 12. It's just the picture of what I'm trying to say effectively. So this shows the three largest fiscal programs that America put on during the pandemic. And if you look at the basically the second and the third on the right, so the Rescue Plan and the Consolidated Appropriations Act, and you look at basically how people have used this amount of fiscal deficits. I mean, you just look at this chart. So 50% used it to pay off debt, 30% saved it, and only 20% spent it. And the most important part of this is that 50% actively chose to use these new checks to pay off debt. And please bear with me for a second. We discussed before that credit creation is actually printing new, potentially inflationary form of money into the economy. Paying down debt, so basically canceling an existing loan, is equivalent to destroying money. All right. So it's just the
I'm with
opposite
you. It's the exact
process.
opposite of what it is. So it's actually
So,
deflationary.
yes. So America has actually net looking at the public sector and the private sector, printed way less money than you think. It's still massive. Don't get me wrong. It's absolutely huge, right? Compared to the output gap that was there. But, because the private sector has chose to pay off existing debt, it has effectively destroyed half of the second and the third fiscal spending plan that the government has actually put in place because they have deleveraged. This is what happened as well in Japan when the private sector took most of the deficits that the government was trying to print and decided to simply offset them. I don't know if I have the chart in the deck. I don't think I did, but I can mention it. So Japan has been printing forever fiscal deficit to GDP. If you plot the primary surplus, so the primary deficit of Japan compared to GDP for the last 30 years, you can't find a single year where this is not in deficit. You cannot find it. It's always in deficit. And over the last 4 to 7 years, I think the average was about 4 to 5% of GDP. Every single year, Kevin, 4 to 5% of GDP in deficit by the government, right? And then you have the Bank of Japan coming in and buying even more than that, right? So it's that monetization between brackets plus, all right, for a pretty decent amount, pretty sustained amount of time, and the Bank of Japan accommodating the process, right? So where is the inflation? And the answer to that question is that the private sector has been puking on this. The private sector is not accepting this newly created form of money as, an opportunity to go out and try to do something with it or try to spend it. It's at best saving it. At worst, it's paying down debt. And by the way, the residual part, which is fiscal spending, also needs to be put at some point into productive investments. I mean, Japan has built roads to nowhere. There have been countless infrastructure plans because the feedback I get is also that infrastructure spending is different than the government sending checks to people. And that infrastructure spending then is going to be inflationary. Well, you can check how much Japan has done in infrastructure spending, and you can check how much, quote unquote, that monetization has been there for the last 7 years. But that hasn't meant automatically that Japan has created inflation, has it?
Right. No, Alfonso, I'm going to give you a huge shout out here because with your letter, you were counseling very much against all of the hyperinflationistas, as I like to call them. You were saying that this inflation that we thought was about to descend upon us wasn't going to be that way. And one of the things that I thought was so interesting was you were counseling that for your own account, you were buying flatteners, which is the exact opposite of what most people have. And you were saying things like you should buy growth stocks and sell value. And this was very much in contrary to what was the consensus and the conventional wisdom. Why don't you tell people why you felt that way and why, and if you still do?
Yes, I still do. And why do I feel and I felt that way is because of what the macro compass was telling me. So this is basically a very simple 4 quadrants compass or chart that guides me to make medium-term macro investment decisions. It's in chart 4. And you can see that it's driven by 2 elements on the Y and on the X-axis. So on the Y-axis, you will see the monetary policy stance, or I should say the relative monetary policy stance. And on the Y-axis, you will see the global credit impulse. So basically, as you move right or left or up or down, you will end up in a quadrant. And, there is a quadrant for secular trends. There is a quadrant for the high beta risk assets. There is a quadrant for the real economy stuff. And there is a quadrant where you want to get rid of about everything you have and hide into dollar and VIX. It's a pretty simple picture, but the most important stuff is to understand the y-axis and the x-axis and how do you move along this compass, right, to make your investment decisions. So the reason why I didn't have the newsletter yet in May, but I was active on LinkedIn. So if you go check myself on LinkedIn in May and then on the newsletter in June, I started warning people that we were shifting from the right side of this compass to the left side of this compass. And the right side encompasses basically credit creation acceleration, while the left side is credit creation deceleration. So we are decelerating in credit creation on the left side. So I should maybe define what this global credit impulse is. First, let's start from credit impulse. So this measure is able to identify the potentially inflationary form of money that is being pushed through the real economy at any point in time. So it takes away any of the purely financial or interbank side of the equation, and it focuses on the money that is able to reach the real economy. It doesn't mean all of that is going to be inflationary immediately, but it at least narrows the scope, right?
How do you figure that out? Like, where do you grab that from, Alfonso?
Yeah, it's basically a prop metric that uses 18 different data sources.
Okay.
The data sources are all public, but you basically have to look at the commercial banking sector, the shadow banking sector, net borrowing by the government and other entities if relevant. And you'll have to be able to weight them, and then you can use this metric as a percentage of GDP to grasp whether the pace of change of credit creation is changing, because that's another important element. So if you have a gargantuan fiscal stimulus this year, right, and then next year it rolls off, right? So there is no big checks anymore coming to your account. If you want to keep up the year-on-year pace, next year you'll have to be able to send me at least the same check. And if you send me at least the same check, Kevin, you achieved 0% year-on-year growth. Would you agree?
Yeah, I'm with you.
Right. So this credit impulse is able to tell you whether the pace of change of credit creation is actually accelerating or decelerating. So this is not a velocity metric. This is an acceleration metric. Okay. And I found out that the acceleration in credit or deceleration in credit is what matters the most, rather than the absolute level or the change.
Okay, and this, therefore, was this why you thought we were shifting from the one quadrant to the other? You saw that this credit creation had stalled and was about to head negative?
Yes. So basically, it had plateaued in Q4 2020 as the result of government-guaranteed bank lending that had picked up in 2020, but then came to a halt in Q4 2020, and net deficits that had picked up massively in Q1 to Q3, Q4 2020, and then in 2021, they were only there for a smaller portion in the US, but not in the other G4 countries that I analyzed for that. So effectively, this is telling you that when credit flows to the real economy and the acceleration of this credit flow is there, then if you give it a little bit of a lag, generally between 4 to 6 months for GDP and earnings, and then, 8 to 12 months for financial markets to fully appreciate what's going on. If you give it this time lag, you will see a pretty good correlation between the credit flow, so the acceleration of this credit flow through the economy, and earnings picking up, and then risk assets doing well, and all the reflationary trends doing well, right? So this is exactly what happened between October 20 and March 21. And actually between September 20 and March 21. You saw this huge amount of credit being sloshed to the real economy early 2020. You gave it about, 6 to 12 months. It really depends on which metric you're looking at as a leading indicator. And then it's reflected into the economy, and you get all the reflationary trends ongoing, and you get the usual, this is a regime change. Oh my God, this is, it's all gonna, the ceiling is gonna come loose, and this is now, yield curve is gonna go to, and the 10-year yields are gonna go to 10%, and the curve has to be steep, and you get all of that, right? And that's fine. That's okay. You got to appreciate the narrative. But once this credit impulse had peaked in Q4 20, you also know that with the 6 to 12 months lag, some cracks are going to start to appear there in these reflationary trends. And that's what I was warning people for, effectively, that we were moving on the left side of the quadrant, where you go back to the secular trends. If the monetary policy doesn't become too restrictive, or you even risk to go into proper risk-off episodes if the monetary policy authority wouldn't recognize that this credit creation decelerated and would tighten monetary policy against it.
Okay, so you switch over. You're in the flatteners. You're in the growth stocks again. Why don't you explain to people why you own growth stocks? It seems counterintuitive, but there is a reason for that.
Well, I think when you structure a trade, you'll have to think of the risk-reward of this trade, right? So people ask me, why are you not simply outright short equities? right? I mean, that would probably make more sense. So, and my answer is that wouldn't really make more sense at this stage. The reason why is to be outright short equities, you not only need earnings decelerating as a result of credit impulse decelerating, but you also need the valuation side of things to get, worse. And in order for that to get worse, you need the worst possible combination that sends you to quadrant 4, which is the worst possible quadrant, where the monetary policy authority is not accommodative enough to match what the market is asking for. And at the same time, credit creation is decelerating. Well, how do I define the y side of the axis? One way to look at it would be chart 3. So I would look at R star. R star is basically the neutral real interest rates at which the economy can run at its own potential. So it's an interest rate that is not too accommodative, not too restrictive for the economy. And if you leave it be, then the economy will achieve its potential growth if you run at this rate. So you have to estimate this R star. This R star is estimated to be about, in real terms, about 0 to 1% in America. Okay, in real terms.
Okay.
And then you look at the federal funds rate in real terms against that. And then you look at the extrapolation on the forward curve of these real interest rates against this R star. So it's a relative measure of how today's real interest rates that feed into today investment decisions and borrowers and creditors interaction are doing against a theoretical estimate of a neutral real interest rates. And with that, it's one metric to grasp whether the monetary policies are accommodative or not. And you can see that every time real interest rates go above this estimate for R star that I have for myself, you have a problem. I put some orange boxes there. So every time real rates go, between 0 and 0.5% higher than the estimate of R star, you have a problem. You have a great financial crisis. You have the China slowdown scare. You have the Fed will be on autopilot sell-off that we had in Q4 2018. But look at where we are now. We have Fed funds, real interest rates, real Fed funds, if you wish, that are, very, very negative. You have 5-year real interest rates that are very negative, 10-year real interest rates at negative 1%. And my estimate for equilibrium real interest rates in America would be, anywhere between 0 and 1% in real terms. So in absolute terms, monetary policy remains very accommodative. And the path of travel and direction is very important, but I don't think we are there already for quadrant 4. So if you don't think we are in the scary quadrant, then one way to express this would be the secular trends. Lower yields, flatter curves, long the stocks that benefit from secular disinflationary trends, and short the stocks that don't benefit from that. So my recommendation now is long Nasdaq and short Eurostoxx banks, because any bank needs a steeper curve to function and make earnings with this maturity transformation business that they have, right? I mean, deposits are shorter in duration and their assets are. So the steeper the curve is, the natural, more naturally banks are going to make more margins, and this is going to be reflected in their stock prices, right? And in Europe, to have a steeper curve now, it's really complicated. So I think medium-term European banks are, not the best place where to be in general financials in Europe, while I think Nasdaq is probably on a relative basis one of the best places to be if you believe disinflationary forces are there. So you structure a relative value trade that even if you would go into quadrant 4 would still work, I think, because Nasdaq would be interpreted as a proxy for long duration safe asset. Somehow of a proxy to that, it would have a beta to yields, positive beta to yields. So if yields would drop, positive beta to bond prices. So if bond prices would go up, then somehow I would expect the Nasdaq to take less of a hit than highly cyclical industries like financials would. So I think it provides you with a decent risk reward.
So Alfonso, I have to give you all the credit in the world though, because you're saying, first of all, you nailed this trade. I watched you do it. It was a terrific trade. It was bold. It's against consensus, and you're sticking with it in terms of even now as we sit there, you're well on side, and you think it's headed more, and the market seems to be agreeing with you, which is the most important part. Do you think that this move in the Nasdaq that we've had over the past, let's say, couple of weeks, is a function of people waking up to what you see and kind of we're forecasting?
I'm seeing the Nasdaq as we speak at above 1500, so it's going pretty well from that leg of the trade. The cyclical side of it is holding okay. If we look, for example, at Nasdaq versus Russell, I would expect a relative value trade, guys. This is not an absolute trade; it's a relative value trade. It's one leg against the other. So if the Nasdaq drops 10%, but the Russell drops 20%, you would be still be making money on this trade. If I mean, for you, Kevin, it's probably easy, but I want to make sure that everybody gets that. It's a relative value trade. If you look at chart 5 and 6, what I did here is I overlaid the G5 credit impulse as percentage of GDP. So that's the blue line, and it's measured on the left-hand scale against the Russell versus Nasdaq total return indexes with a 10-month lag. Right? So you can see that although, and I want to stress this out, this is not a crystal ball indicator. So this sets the direction on how to think about your macro investment thesis as you move through the quadrants. But you will not see perfect correlations. Any statistical study on this will show some decent results. I use it as a guide to structure my trades. And what I see on this is that the global credit impulse has peaked in Q4 20, and therefore the Russell versus Nasdaq trade should peak at about 10 months later. So Q4 20 plus 10 months is about now, right? We are 10 months forward after Q4 20. We are in July 2021. And the price action is reflecting this pretty well. Now, the credit impulse, of course, took a bath on year-on-year terms because we simply won't be able to replicate what we did last year in terms of credit creation. Now, does it mean that I expect the Russell to underperform the Nasdaq by 40% over the next 6 months? Well, that seems a bit exaggerated, but at least I know that the direction of travel is not for reflationary trades anymore. So I want to position myself on the other camp of it, and if I can, I want to also have a decent risk reward as I structure my trades.
Although, Alfonso, you say that it's not 40%. It's not that realistic at the rate we're going these days. It feels like it might be. So I'd love to chat and bring it back. Those are kind of your short to medium term trades, but I'd like to think back to this environment and the way of explaining how the market works and how economies work, and try to figure out if there's a way that societies will ever be able to break out of it. Because to some degree, you've painted a picture here that shows a tendency for disinflation. And I guess at the crux of the matter is that you're looking at the high level of private sector indebtedness, and you're saying that the reality is it's going to be difficult with that private sector high level of indebtedness for us to get inflationary credit growth. Is there any way you could see a situation where you start changing your kind of, let's just say, home-based stance, where you say, now we're in an environment where we're actually going to get that private sector credit creation, and then I should be leaning more towards that kind of growth and / inflation quadrant? That should be more like what I should be counting for as the let's just say the neutral spot.
Yeah, so before I answer that question, I'd like to stress out I do not like maximalists of any sorts. I do not like permanent dollar bears, permanent dollar bulls, Bitcoin standard people. Well, it's not that I don't like them, but having the confidence to assume that you always have a probabilistic scenario of the world. By definition, as you're not God, you don't know how it's going to turn out to be. So you can make some assumptions and you can have some future scenarios. I think it's pretty arrogant to have one scenario and attach 100% probability to that scenario to realize. All right. So, of course, I was also the first one 9 months ago to point out that I thought US core inflation could overshoot 3% for several quarters temporarily, because, of course, there was a large amount of credit impulse being thrown to the economy. Therefore, short-term inflationary forces would pick up. So I would be the first one, Kevin, to change my mind if structural facts actually change.
Okay.
So that was your question.
Yeah.
What change?
What would be those structural facts? Like, is a disinflationary trend just inevitable, or is there something like we could do as a society and as to change that? And should we change that?
Very good question. So, what would make me change my mind? So, you either would have the structural forces of the economy turning for the better. So, this would be either increased birth rates or anyway material demographics changes for the better.
Okay.
Or that would be better allocation of capital throughout the economy and therefore in general better productivity. So let's talk about this capital allocation, because QE drives capital misallocation. And it does that because it keeps real interest rates very low and therefore allows a bunch of companies to repay or to keep afloat on their debt servicing costs, despite these companies not being very productive anyway. And by doing that, it incentivizes, capital to chase high-yielding risk assets, despite maybe those issuers and companies are not really productive and not worthy of attracting capital, right? So with this asset valuation and this wealth illusion where we live in, there are effectively two ways that I think we can try to handle that, or what the political agenda would force us to handle. The first one is what we're trying now, and it's financial repression. So what you do is you force real interest rates below real GDP growth for the government, or in general, real cash flow capacity generation from the private sector, such that in real terms, over a very long amount of time, you will have asset owners being penalized, so their purchasing power shrinks as they are forced to buy these bonds, which yield below inflation levels. And you have the borrowers that actually get the benefit of having their debt being inflated away, and as they need to pay effectively very low real interest rates below their capacity to produce real cash flows or real GDP if you're the government. So this is basically an environment of financial repression.
Okay.
This obviously generates other problems, because as you try to do this for 20 or 30 years, and you really need a lot of time to repress the system into lower amounts of debts in real terms, you will face higher asset valuations, higher inequality, and social unrest of any form at some point, right? And political shifts, which are very difficult to digest. But this is the way that we will go for. So we just started this, and it will continue for decades, in my opinion. This is my base case scenario to which I attach a decent probability. It's not 100%. I don't have a crystal ball. But if I would have to assume, this is the way we're going, because it is the most politically acceptable or sellable way. It doesn't mean it's the best one, but it means that politicians can keep on doing that and hope they will be re-elected in the next electoral cycle. And it is a slow, stealth drain of purchasing power from the private sector that compounds over time, but for the next year or two, it might still be okay. And for a politician, as long as it is okay for the next electoral cycle, it's a decent incentive scheme for him to go this way. Because what would be the alternative would be upfront wealth destruction. So that would simply mean that we would mean revert asset valuations to levels that are more consistent with our structural capacity to produce earnings and cash flows to service debt in general, debt levels, but also to make sense of this assets valuation. But to do that, you need wealth destruction all over the place.
Right, like that's like an Austrian style, debt reset.
Yeah, so basically a massive
which is
leveraging
never going to
process.
happen. And so you think that this is the long and short of it is that we're going to have this slow, steady kind of financial repression, and because this financial repression will really never escape velocity or never achieve escape velocity, it's going to just be this pull and push, and that yes, asset prices might rise, but we will not be achieving the optimal level of economic output because it's not being allocated correct. Is that fair to say?
Yes, I would say so. I mean, the painful reforms that you'll have to go through to make your system more productive, and also to increase long-term prospects for potential growth, are very difficult to sell. Is it not much easier, Kevin, to just borrow and extend credit and then go through the next electoral cycle as a winner and then leave the problem to somebody else? But then he would then do again the same when the next financial crisis hits. So it's simply kicking the can down the road. But at some point, you also need financial repression on top, because private debt levels have reached points into which you need real interest rates to be extremely low for the private sector to be able to digest these debt levels. So you will need to go with financial repressions. I don't think there is any other viable solution.
So you know how we talked before how loans make deposits and not the other way around?
Sure.
What about the idea that that also applies to governments, and that deficits make deposits and not the other way around? And that the real problem is that we've been running a fiscal policy that's too tight. And if we agree that a currency issuer is never faced with a financial kind of repayment problem, and it's always a real in a real basis that they're faced with that. What about the idea that if we were politically willing, we could run deficits? And I know that that has a kind of bad connotation, but let's just say that we put all of the extra unemployed people to work and we used a deficit to do that and pushed it out into the system. And that, what about the idea that that could get us out of this kind of self-reinforcing disinflationary / deflationary loop? And that the real problem is that we're running a fiscal kind of policy that's incorrect.
So I don't think I'm good enough to foresee exactly how that system would work. I think it is an interesting proposition, at least to consider the government as a currency issuer rather than a currency user, which means that you can run your fiscal policy much more loose, because there is no, you don't need to worry about your cash flows and your ability to service your debt via cash flows. I think that's an interesting proposition. What I struggle to see is how effectively a centrally planned economy, because here what we are trying to picture out, Kevin, and correct me if I'm wrong, is an aggregate demand source that will ultimately come from the government. So the government will set where the money is spent and flows to the real economy for the largest portion, and will also drive aggregate demand cycles up or down.
Well, it doesn't have to be quite so all-encompassing. We could also just be tax-less and do some infrastructure. To me, it seems like it's a very pessimistic outlook, in that we are faced with this disinflationary tendency that we can't escape. And I'm just trying to understand, is it really as inevitable as we believe? And I've said for a while that I believe that governments can always create inflation if they want. They just need the political will. And I'm willing to accept that we as a society are not prepared to do that, and therefore we suffer from this disinflationary tendency because we aren't willing to make the inflation. But I think that if anything, COVID showed us that we can actually fill the holes if we want. Like, we take it for granted, Alfonso, that right now that the government filled that hole. But don't forget, there was plenty of bears out there who thought there was no way the stock market would go up or that the economy would be able to handle the COVID crisis. They thought that, oh no, this is coming, there's nothing we can do. And yet the government has kind of showed us to be wrong. We've accepted it now, but it was only a year and a half ago that everyone thought the exact opposite. Go back and look at what most people were saying in March of 2020. It was inevitable that the economy was going to collapse. So I just think that just like in 2020, we saw a situation where we didn't think that the government could, the fiscal policy could actually help us out of this hole as much as we did. I wonder if we're also doing that on a secular basis.
Now, the proposition you bring to the table is definitely correct. The role of the government is most likely going to increase on a net basis rather than decrease going forward. And the reason why is that there is no alternative. I mean, the private sector can't take it anymore. It's very clear. They're telling you they're over leveraged. They don't want more credit. So therefore, I mean, the only chance you're left to, in order to continue overlaying credit to achieve cyclical growth on top of very poor structural growth, is to put the government in the equation, right? And then you say, okay, well, you guys are going to have to take over and do some more fiscal spending. And I think you're right on that. I think they've shown willingness when we really have a problem to back us up. Now, I have a little bit of a problem with the government being a productive allocator of capital. Well, capital, of newly created money. Let me put it like that. I don't think they have a good track record to start with. And I don't know, I would debate the interaction between the public and the private sector. So
what about if we taxed less than instead of spending more?
Yeah, it's basically the same thing. So taxing is nothing else than draining assets from the private sector and putting them on the public sector balance sheet. So what you're basically suggesting is to move private sector debt burdens over the public sector in some form or another. It can happen over time, right? I mean, you can tax people less, so they have more spending power. They can use some of the spending power to reduce their debt, which is just another way, effectively, of moving credit or debt from the private sector to the public sector, right? Because as long as the public sector doesn't have any material constraints in terms of cash flow, why would the private sector be indebted, right? I mean, let the public sector do the work.
Yeah.
And I think this is a very interesting proposition. The only thing there are two things that I would comment on that. First of all, from what I read, as a follow-up of the massive fiscal stimulus we have done in 2020 and early 2021 to fight the pandemic, the politicians are definitely not ready for this. So they're already talking about raising taxes and how do we pay for the next plan, which is how do we drain resources away from the private sector that we have tried to put into the private sector in the first place. Yeah.
So
that's the discussion.
Alfonso, I completely agree with you that the economy, the people aren't ready, and that really it takes whether it be a war in World War II, when you saw them allocate a whole bunch of resources for that, or it takes COVID, which is a war on the virus. Those were extraordinary times that allowed them to run those sorts of deficits, and that we will revert back to that belief that that this money needs to be paid back.
Yeah, so I agree with you. So I think it's an interesting proposition. I don't think the system is ready to absorb it, from what I read, even from the US, which is supposed to be the more advanced, large developed market in this discussion, because if you look at Europe or Japan, just forget about it. And the second one is that, again, the resource allocation coming at that point from the government more than from the private sector, I don't think it is the most productive that you can have. So those are the two comments I would make.
Okay, so Alfonso, let's finish with our three questions. Let's start with your favorite investment book.
So I would have to say this goes to either, let's name two. One is more theoretical, and it's Cullen Roche book. Let me try to get the name here for you before I get this one wrong. It has the Pragmatic Capitalism, what every investor needs to know about money and finance.
Okay.
So I would shout out to Cullen. I think this book is really, really good, and is able to explain most of the things we're talking about in a very simple terms. And it's also pretty short book, easily digestible in a few days. The least theoretical version of this is Steve Drobny's book, where, again, I'll have to get the title. I'm horrible with the title. Yes, Inside the House of Money, where he interviews hedge fund traders mostly, and I think a couple of treasurer and real money people out there. But it is a fantastic book. You get so much of how to handle risk, how to defend your drawdowns, how to think of the world in that book. You'll have to read it a few times. I think that's an amazing book.
And then, the next question I have for you is: great traders / portfolio managers, are they born or made?
They're made. They're definitely made.
Oh, okay. You think you can learn all these things? It's not something you're just kind of an inherent ability.
No, but first of all, I'm not a great trader to start with, so you should ask the question to somebody else. But if I would look at great traders around me, I would say they're mostly made. So of course they have a sense for risk and how to take risk rightly, but they've definitely learned, studied a lot, and studied is not the right word. They have a passion for this. So they just like to discover more about the world works and how macroeconomics work, but also they're religious about their risk discipline. And you must be. And that is something you can learn with hard work. You're not born with that.
Okay.
You learn how to do that.
And then finally, if you were to talk to somebody that's starting out in this business, what advice would you give them?
So 2 advice. The first one is to make sure that your education and your interest is complementary between theory and applied studies. So applied studies can be you learn how to code, or you know how to handle data. It must be something that is applied, not only theoretical. It's very important. And the second advice I would give them is be curious as much as you can, and try to suck up knowledge from people around you as much as you can. Do not hold on any questions you have. If you have an internship, just be the most annoying guy out there, listening to every conversation you can. If you have somebody who's willing to mentor you, just do it. Just do it, and choose a wise guy that knows what to teach you. And do not underestimate the soft skills, which are required in life, because your hard skills can get you very far, but soft skills are required to get you much further.
So that's some great advice. I was kind of laughing about your first comment there about applied and theoretical. So do a little Italian and a little German.
Yes, basically, yes.
Okay, so Alfonso, why don't you tell people about your letter? It's a terrific letter. It's free. Tell people where they can go and check you out, and where they can sign up. And don't forget to tell people about your Twitter, one of the best Twitter accounts out there. Give us the whole spiel.
Sure. So you probably are familiar already with the Macro Tourist newsletter from Kevin here. So it's on Substack as well. Mine is on Substack too. Mine is free, and it's called The Macro Compass. So you just type in Substack or on Google, you will be able to find me. It's on Substack. I started that about 7 weeks ago. It's going well, so I will post about once a week what I think of markets or a special topic. And otherwise, you can find me on Twitter too. The handle is @macroalf, A-L-F, macro A-L-F. And there I just, put things open in the air. I do not delete tweets. I do not block people. If I have a terrible trade, I will say I'm wrong. I have no problem with that. And I will stop out, and I will just not pretend that I get 100% right, because nobody does.
Well, that's great. I highly suggest that people go to both of those. The letter is outstanding, and as I said, I think it's one of the best Twitter accounts out there. Before we go, I got to talk to you. I got to give you a big shout out for your team, your football. I'm supposed to not call it soccer. You must have been a pretty happy fellow, even though you live in the Netherlands. What was that like?
Oh, it was nice, because these guys in the Netherlands are very proud about their football team. So they had all their flags around, and I didn't feel I was in the majority. Let's say, of course, I'm Italian living abroad, so by definition I'm not. But these guys were kicked out by, I think, Czech Republic, and they thought we were an outsider in trying to win the Euro Championship. So it was worth double for me to see the actual triumph.
Now, is the hatred of, like, when you were looking at England versus Italy, is the hatred of England overwhelm most people, and even the Netherlands vote kind of were rooting for Italy, or no?
Yes, I think even the Dutch managed to root for Italy. Which, if you get a Northern European to root for Italy, I think it's a stretch. So only the English could actually achieve that, I'm afraid.
Oh well, listen, Alfonso, it's been great talking with you. Thank you so much for your time.
Hey, thanks, Kevin. An absolute pleasure being here. Thanks for having me on the show.
All right, Patrick, it's time for Talking Charts. What do we got?
All right. Let's start with reviewing what our top 3 things we were watching last week. First thing, we were talking the ECB, more nothing, right?
Yeah, more nothing. They tried to make it sound exciting. They tried to make it seem like they were doing all sorts of fancy things in terms of forward guidance, and it's really just a big nothing burger, as expected.
All right. Well, number 2, bond yields, which spurred on the bet. But, those bonds continued to rally. But, I mean, it really ended very quick in the week and kind of has been retracing since as the stock market's been rallying. But generally, the trend of lower yields seems to still very much be in play.
I'll for sure give it to you, Patrick. It's there's no doubt about it. Early in the week, we had just a screamer of a rally. I'm sure it gave up a little bit at the end of the week, but the trend's still down.
Yeah, well, we'll settle this up when we get to the skin in the game. But the number one thing we were watching was rolling correction or something more, and it was really just a rolling correction. And the S&P 500 just goes screaming to fresh highs, and the FANG stocks led the way. I mean, Facebook and Google just monstrous up days, and the FANG stocks doing their fair share of getting this market back up and running. And really, it was not something more, and at least not yet. And that was definitely the case. So that was last week. But so let's talk about what we're watching this week. And the first thing I wanted to start with, Kev, is just the one trend continues to be that shift to momentum from value has really, from a factor perspective, continued. I mean, really since the summer of last year, and really picked up when that reflation trade started in November, where we're using now, by the way, the MTUM ETF, or momentum stocks, versus value, which is the ETF, or VLUE. And really what we saw was a very distinct outperformance of value over momentum, which is that downtrend in this chart. But really since mid-May, we've really seen nothing but a sustained outperformance on the short term of momentum. And now it's obviously being reflected in the rotation into the FANGs, but this doesn't seem to quit here. And it does, so one of the things I'm watching, whether we can hold here above like these 3-4 month highs, right? Like this has been sort of the range that we've seen here over the last few months, and it looks like momentum's trying to break out here, and we'll see whether that continues to be where the alpha is in the market. You have anything any opinions on that?
It felt panicky to me, Patrick. It definitely felt like there was something up, that it wasn't just let us say a well thought out, let's get into growth. I think it felt like somebody was panicking to get this trade on. It started Monday morning, we got up and the S&P was down 30, 40 handles. It might have even been more. And since then, we've ripped, and it's ripped completely with the NASDAQ leading the way. And it's those 5 big stocks. And there's all sorts of theories that I have, but one of the things that I look at, Patrick, is the fact that China is doing a lot of funky things. We're seeing some really poor performance in their tech stocks. If you go pull up the KWEW, it's been just sucking in for a while.
But just pulling up Alibaba or any of those, Tencent or any of them, they've just...
It's almost a mirror of the NASDAQ recently.
Yeah.
And then this morning, we're taping this on Friday, this morning we had the education stocks. So all of a sudden you wake up and you thought you were running a for-profit company. And now all of a sudden you're in the not-for-profit sector of the economy. Yeah. It feels to me that maybe that money that was previously in those Chinese tech stocks is looking for a home, and they're selling those and they're saying, what do I buy?
So
and
that's an interesting thing. I never thought about that, but maybe it's the real rotation is out of these Chinese internets and into the FANG.
That's my theory about what's happened.
Well, that's clearly been moving in the exact opposite direction of each other. There's no doubt about that.
And just the sheer kind of panic about it didn't seem like, what was it, yesterday that we just ripped after the close? And the other thing that I would say is it feels to me like it might be a huge program. The relentless nature of it is just the bid and bid and bid and bid. And one of these days what's going to happen is it's going to get filled. And I think that it's going to be a quick swoosh. And the one last
quick swoosh.
A quick swoosh. One last interesting thing that I'll kind of highlight is that today, even though we were going into the weekend, even though the stock market was screaming, VIX was bid all day. and not the absolute index.
Yeah.
I'm talking about the futures and the VXX product.
Wow.
And
I didn't notice
when
that.
you see that, my antenna goes up. So color me skeptical. I'm not.
So you're not buying then you high.
Yeah, and in fact, I'm looking for that noble animal maybe coming out here.
Really?
Yeah.
You know that on the chart. Well, we'll talk about the chart in a moment. Let's pull up the S&P as one of the first charts when we get to the main charts. Let's move on to number 2 first. Number 2, we have the FOMC coming up next week. Is there something particularly you're looking for from Powell or anything?
Well, the real question is, has the Delta variant pushed off the tapering? And will he sign? Because he signaled, let's face it, what was it, a week ago, last week, that he signaled he took another kind of dovish, kind of slight walk in that direction. Okay. And the question is, does he affirm that? I'm not sure, Patrick. I'm not even sure that he knows. There's a lot of different factors that he's juggling in terms of different people on the board. Because although he is one member that does influence it tremendously, it's still a board made up of a lot of individuals. And part of me thinks that they're getting nervous about the quantitative easing, the size of it. And one of my beliefs is you always ask yourself, this Powell doesn't like being in the headlines. And what gives him more headlines? Him quietly just, letting QE start to run off, or him pushing through and doing more of it. And to me, it seems that increasingly continuing it is going to cause him to be more headline specific. I kind of I highlight the 60 Minutes episode. What was that on Sunday night? There was a 60 Minutes episode. It was basically just every old curmudgeon complaining about QE, and it was 60 minutes of this. And it was nothing new, but to me it seems that you get a situation where Powell might start saying, you know what, It's not worth it. It's questionable whether QE does anything to the real economy. Anyways, stock market ripping to new highs. Why don't we do QE? So even though I'm a big believer that this Fed is a kinder, gentler Fed than the ones in the past, it probably has more to do with interest rate moves than quantitative easing moves. And I suspect that we might see some surprises that we get the tapering announcements sooner rather than later.
Really?
Yeah,
Okay.
that he surprises in terms of versus expectation. Like, I don't think he's going to start tapering tomorrow, but just versus expectations, he might meet and exceed the hawkish guideline or timeline that we see.
I find that the questioning always comes in a way to try to stumble him up and catch him to say something that reveals some further information than that's on there. Do you think that what do you think do you think have an opinion as to what would surprise everyone if they managed to get him to reveal some information through the Q&A?
In terms of I think that if there's going to be a surprise, it's going to be that the Federal Reserve is closer to tapering and instituting that than the market expects.
Wow!
And if there was something
that could make the market have a shakeout,
right? But if you're sitting there and you're Powell, although everyone that's involved with the market thinks that he tunes for the market, he doesn't tune for the market, or he shouldn't be tuning for the market. He should be tuning for the real economy. And so the question is the QE doing anything for the real economy at this point?
Yeah.
It's hard. I'm hard-pressed to say that it is and that it's needed. And if that's the case, then it's probably time for him to do it and to get out of the way. And especially since the chorus of complaints is growing louder and louder. And I still contend that he hates being in the headlights and or the spotlight. And if this gets him out of the spotlight, I think he'll do it.
All right, so let's go to number 1. I wanted to talk about this commodity index. And we for several months have been talking about breakdown after breakdown in commodities while oil continued to press new highs. And yet we got this oil correction. Oil goes, we'll put up a chart in a bit to talk about it. And yet you take the Bloomberg Commodity Index and it's about to break 52-week highs. And it's an interesting thing that overall the commodity basket has not quit. And one of the things I want to watch next week is whether the broader commodity index breaks out, and whether commodities like copper that have been more or less correcting for 2 months now actually do something on the upside. I mean, lumber is so oversold. We got the reactions there, and we can look at some of these different charts here in a moment. But isn't that interesting that the commodity index is holding up like that?
Yeah, I guess I'm surprised it's breaking out to new highs. I did not expect that for sure. And given that oil is such a big portion of it as well, you wouldn't have thought. Having said that, even though oil did go and hit your target, kudos for you, by the way. Well done. Well played. It's right back up there.
You could give me kudos all you want. I didn't buy the dip. Which you could have given me kudos if I loaded up the boat and was buying $65-$66
I know,
oil.
but you told us that's where it was going to stop.
Yeah, but did I follow my advice? I have to admit that I did not. I do like buying my dips, but this one I legitimately failed to do. And
it was just so fast. That's the other thing.
Well, it's not fast. Like the bottom line,
it was fast.
I buy
oil
the price
did it
level.
in 2 days, right?
Doesn't matter. I buy price levels when they're there, and I chose not to, and that just shows you that maybe I should not use discretion and just frickin' do it anyway, and just when it's there. But anyway,
well, you could also look at it as the reason that it bounced was because you didn't buy it.
That's probably the case.
So that's
now I'm suffering a proper
stuff to send your thanks to Patrick at bigpicturetrading.com.
Exactly. Just send it my way. I make the call right and make no money from it. There you go. Anyway, so let's talk some charts. All right, so S&P 500. Look at that break to a fresh high. And you just were talking about that. You're looking for the prairie dog, and I found that really interesting that you're saying that. But once again, it's a few stocks that are really driving this. And let's look at the two big FANG stocks that made the move. Facebook goes ripping from $350 to $370 in 1 day. I don't even know what the news was. Was there a headline that was associated with this?
I don't know.
It's just, but what a move, right? That's a 52-week high, fresh break, just like this is panic buying into Facebook. And another one that did that kind of a fresh breakout is Alphabet, Google. Look at this. After just a 3-day break, the thing comes out ripping higher. If you're asking what's driving the S&P up, well, don't look any further than these types of FANG stocks that are just these behemoths in the index, and they're just taking that S&P higher. Right?
I think it's all the Alibaba money, all those, everyone that's selling those and trying to figure something to buy, that's what they're buying. I really do think it's as simple as that.
Well, I don't know if it's that simple, but it certainly makes sense. I'm not going to push back on it. There's got to be some of that money flow coming in there. Anyway, the equal weight in S&P not making higher highs. NASDAQ, though, did make that higher high. But what's interesting is the Russell's dragging its heels. The small caps get no love here. This is not even large caps. This is mega caps running, and the rest of the stock market being left behind. And that's where I wanted to use this opportunity to kind of talk about the market breadth, right? Because when we talk about the New York Stock Exchange stocks and some of the breadth indicators, they take into account thousands and thousands of stocks, not just the Apples and Googles and Facebooks. And the Russell, which is 2,000 of these more smaller cap range stocks that are still a part of that broader NYSE, just can't get off of the mat. They're basically trading a stone's throw away from 6-month lows, at least of this trade range. And that's certainly where none of the money flow is going. But what I thought was really interesting, Kev, is, S&P 500 is at 52-week highs. More importantly, in the last 6 to 8 months, the S&P 500 off of that November low is up 37%. And yet, you go to something like the CNN Fear Greed Index, which is a measure of sentiment based upon their 7 metrics. It was yesterday at extreme fear, reading down into 23. And earlier in the week, the thing was at 15. It's basically showing levels that would be typically associated with the end of major market sell-offs, where sentiment is bottoming out and everyone's panicking out, and the stock market is at all-time highs.
That's a great point, Patrick.
It's and
That's
another.
I didn't realize that.
And not only that, but let's go back to that percentage of stocks above their 50-day moving averages, which is that breadth breakdown that we talked about over the last couple of weeks. I mean, we hit 25. To put this in context, the last time the breadth got this bad, let's look at the last 2-3 years of them. I mean, you go back to 2019, you have to go back to essentially for lower readings, you'd have to go to the Christmas Massacre. You have to go back to some of the 10 to 15% market corrections, including the ones that happened in 2020, like that September and October sell-offs that we had on the S&P back in the summer of last year were 10, 11% market corrections. Like, they were proper shellackings in the market. And yet we hit the same kind of breadth indicators and negative selling just earlier this week. Yet the S&P is at an all-time high.
That's fascinating,
right? Like, and so
I guess to some extent, Patrick, it's because it's all those 5 stocks and everevering else is just behaving like crap.
And this is where I think that there's this this kind of thing of where people are hurting and they're seeing their stocks suffering, and they see the market all-time highs, and there's cognitive dissonance, if that's the right thing to kind of associate it with. Like, people don't and this is probably where so much confusion about the market is actually occurring, Kev. Like, people are seeing stocks they own getting shellacked, they're feeling pain, they're liquidating out, and the S&P is going all-time highs in Project Zimbabwe.
And then even worse, Patrick, is that if you do own some protection, so you own some put protection, and that's also
it ain't
losing.
Protecting shit.
Yeah,
it ain't protecting shit. This is the most bizarre max confusion market. You've suggested in the past, like having just taken off this summer and just gone on vacation is probably the most profitable thing that most investors could have done. Right? But something's got to give when you have this kind of confusion in the markets. You have to think that traders it must be breaking confidence underneath. I don't think that most people are participating with the S&P to the upside.
Oh, Patrick, I completely agree, 100%. I even though the S&P is hitting new highs, I'm hard pressed to find people that are really enjoying this and are excited about this move. Most people that I know, professional traders, they're all, holding their heads down, complaining how much this is hurting and how nothing's working.
Yeah.
And it's across a lot of it's not just the stock traders. That's what I find the most interesting. It's almost across the whole board.
Yeah. Oh, and more importantly, where all of the money was made between November and March, April was in those cyclicals, right? So everyone was loaded up on their banks. They were all loaded up on all sorts of.
But you think that it wouldn't affect the FX guys or the bond guys? It seems to me everyone kind of had the same.
You either been loaded up,
going.
Either you've been loaded up in the fangs and the bonds and you're making money, or you're in the meat grinder right now.
That's true. You had to be really contrarian. You had to basically say, inflation's transitory. I'm going to go put on a flattener. I think that the next move is a return to growth. It really took a true contrarian to have the trade on that was going to
and it's hard to be a stock picker because I as a part of my service here, we're looking for breakouts on stuff like that. I mean, but the thing is finding stocks that are willing to commit to trends is not easy. Literally the breadth is so narrow that the technical setups that come up, very few of them are getting the money flow that is driving the trend move there. It's really weird. Anyway, so let's talk about some of these other charts. But it is, but I think the point is made. It's a very confusing market. All right, so the crude oil had its retracement. It was a nice clean retracement. What was interesting about crude oil was that all the previous highs back over here, more or less acted like support into a fib retracement zone, and we're getting a bounce. Now, what I'm dying to find out is whether or not it manages to retest its highs. There are a number of techniques out there that measure out to like the $80, $85 zone on crude. Now, I'm not trying to forecast as where it's going, but after a correction of this magnitude, typically that starts to unwind the overbought state. And if the bulls are not done, this could be where a trend move begins. Now, I was the first skeptic on oil going to 80, 85 because I know some of these guys that are calling for oil like $100 by the end of the year. I don't know any of those people. Do you know, Kev? Anyone?
No, I don't know any idiot like that.
No. But I was skeptical on that. But the thing is that you know what? If the bulls bought this dip and they stick with this, maybe $80 oil is still not out of line. And that's why I wanted to put that commodity index on our top things to watch, because oil heading back to 75 and trying to break out will break that commodity index to new highs and drive that move. And that, I think that's 100% worth watching. And it's interesting that nat gas don't quit. Right now, nat gas is really, it marches to the beat of its own drum. But this consolidation here measures out to this 420 zone. We're already approaching some of the upper targets of this, but this thing don't want to quit, does it?
Patrick, we had done so well. You hadn't mentioned it in so long. Look how well.
Sorry, buddy.
Look
the
at
one
how
thing
well
that's
it was
working
doing
for you, eh? All right, I'm going to leave it. We're not going to talk the Widowmaker anymore. But let's talk about the attempt for copper to break out. And like this is an example. Now, look, I have heard a number of people talk about the fact that the reflation trade has turned, and I've been very quick to identify some of that turn point. But when you take something like copper, which has now been 2 months in consolidation, it has pretty much unwound much of the oversold state or overbought state that it had prior on the uptrend. And one day does not make a new trend. This is a beautiful screaming green candle. You like when I say that? It's a screaming green candle on the upside. Will this trigger the bulls to come back? And this is the way you're like looking for a prairie dog on the S&P. For me, when I see a big breakout candle like this, I'm dying to find out whether or not this kind of was the spark that needed to drive people back to buying copper, or whether the sellers just give it to them and it fades all the way back down. And that will be a big tell as to how long this kind of disinflationary impulse in the broader commodities will play out. Will copper break out? Will oil follow through? These are such important things to watch next week. And I would actually take a very neutral approach to them. You can definitely try some longs on them, but you have to probably have 1 foot out the exit door if you see that the bulls aren't following through on this.
That's good stuff.
All right. Let me just say, by the way, the dead cat bounce on lumber, I had to mention this. All right. So like, so we on the show, who was it? Was it you or one of our listeners that came up with the Eiffel Tower formation name?
Oh, that was mine.
Was your?
That's actually. I'm proud of you. You read my letter.
Yeah. Well, was it? Was that in your letter? I know. I didn't know. You said it on the show. Don't tell people.
Don't want to get the wrong impression that you actually
exactly. And so, but the point here is on the others. There's a concrete pad at the end of the Eiffel Tower, and it starts on the one foundational leg, and then on the other side is the bottom. And the lumber traders fell off the top of the Eiffel Tower, but inevitably at the bottom of gravity, dragging into the floor is that concrete pad. And there's the dead cat bounce.
I think that lumber, I was talking to a good buddy that follows it very closely, and at this level, 2/3 of the BC forest, like tree stocks, are unprofitable. And they're going to curtail. I think we saw Canfor curtailing harvesting, and we're going to start to see more of them.
How is that the case, Kev? I don't. Maybe you don't know, but there's a question you can ask, because, like, for basically the last 20 years, lumber. Let me put it on a weekly chart. Lumber has always traded over the long term in the kind of $200 to $400-$500 range. So, like, how is it that they're suddenly not profitable when we were at basically decade highs? Must be, but like to
I think
me,
there's also you have to look and there's duties in the U.S. play a big portion of it, right?
Maybe.
So I think it has.
Bottom
to do with
line,
that.
though, is it overshot on the upside. Now it overshot on the downside. Probably going to settle in the under $1,000 range. But I think a reaction back to $700-800 would actually be just a reflexive snapback. I don't think staying at 500 is realistic. But anyone who thinks the bull market back to $1,200-1,300 is going to resume, I'm a seller on that idea. But another $100-200 on the upside from this level, it would be a very typical reflexive snapback from such an incredibly oversold state.
For anybody that's building a house, they should go get themselves long some lumber futures.
Well, you know what? Yeah, you have to, because supposedly Home Depot has not adjusted their lumber prices to reflect the futures. It's easy. They raise it on the way up and then keep it there while it's going down the way down to improve their profit margins, right? So anyway.
No, it was slow on the way up, I'm sure. That's what they'll tell you.
We'll talk bonds. I wanted to pull up bond charts, but we'll talk about that in a moment when we have to settle up a few little things. I think we can leave it at that for talking charts. Was it good?
It was great, Patrick.
All right.
Queen of the markers.
Let's move on.
Okay, this week in trading history, what do you have for us?
This week, we're going to go back to July 22nd, 1944 for the signing of the Bretton Woods Accord. Right, and that's something a lot of people talk about nowadays, especially with cryptocurrencies and stuff. But let's kind of go back and talk about this Bretton Woods. And so the United Nations Monetary and Financial Conference was held in July of 1944 at the Mount Washington Hotel in Bretton Woods, New Hampshire, where delegates from 44 nations created a new international monetary system known as the Bretton Woods system. Now, interestingly, this agreement was signed almost a year before the surrender of Germany and Japan. Like, isn't it interesting that that they were already planning the new monetary system in the post-war period before the war was even won? I just thought it was really interesting that happened that way.
The conspiracy theorists will tell you that they did it then so they could shove things through when no one was paying attention.
Fair enough. Anyway, so let's move on then. That's the countries saw the opportunity for a new international system after World War II that would draw on the lessons of the previous gold standards and experience of the Great Depression to provide the post-war reconstruction. But let's call it what it was. It was an Anglo-American centric system driven as a tug-of-war between the battered British Empire, represented by John Maynard Keynes, and the new economic powerhouse of the United States, which also controlled the majority of the world's gold reserves at the time. America was represented then by the Secretary of the Treasury, Henry Morgenthau, and senior U.S. Treasury official, Harry Dexter White. There's a great book written about this, Kev, and this is where your rib about me listening to the audiobook version comes in, but it's called the Battle of Bretton Woods. And for anyone who finds this story interesting, it's a must read or listen, in my case. So what's also worth noting is that Stalin's Russia originally agreed to be a part of this system, but inevitably walked away, which was one of the underlying drivers of the Cold War and the competing communist-driven central planning economic system of the USSR. Now, they sought to create a system that would not only avoid the rigidity of the previous international monetary systems, but would also address the lack of cooperation among the countries in those systems. So those at Bretton Woods envisioned an international monetary system that would ensure exchange rate stability, prevent competitive devaluations, and promote economic growth. Had the establishment of two new institutions occur. One was the International Monetary Fund, which would monitor the exchange rates and lend reserve currencies to nations with balance of payments deficits, as well as the World Bank, which was responsible for providing financial assistance for the reconstruction after World War II and the economic development of less developed countries. Both of these institutions, which are still in place today, but arguably with much different mandates. the key part of the Bretton Woods was the birth of the U.S. dollar as the world reserve currency, which is still very much in play today. Countries agreed to keep their currencies fixed but adjustable within 1% bands at the time of the dollar, and the dollar was fixed to the price of gold, or $35 an ounce, which was essentially a gold-backed system. Now, what was interesting was John Maynard Keynes, the famed economist who was representing the British, was actually opposed to the U.S. dollar being used as a world reserve currency. But the sneaky Harry Dexter White hid the fact from Keynes, who only actually found out 2 days after the Bretton Woods was signed, when he was already on his way home on the train.
Never leave before it's signed and you check the documents.
No. But you know what? They were signed and they left. But yeah, no, it was. I'm sure they made the documents so thick that it was unreadable. But
always read it before you sign it.
There you go.
Keynes should know better.
He should have known better. Nonetheless, the Bretton Woods system was in place until persistent U.S. balance of payments deficits led to foreign-held dollars exceeding the U.S. gold stock, which inevitably led to 1971, where President Richard Nixon ended the dollar's convertibility to gold, and which followed was the birth of the current fiat system and free-floating currency system, or forex systems we have in place today. And it all was born then, buddy.
I thought you were going to give me your best Lou Mannheim and say that the world went to hell at that point.
Well, it is. I'm just talking facts. Everyone has the right to their own opinions.
Hey, have you ever been to the Mount Washington Hotel?
No, but you know what? I looked up the price. It was like $500 a night. I think I might very well do it.
So I don't know if I've stayed there, but I used to go down to that part of the neck of the woods all the time. It's actually very close to Canada. It's at the top.
It's actually north of Toronto. So those people that claim Toronto weather must be cold, right? This is
this is in the White Mountains, and that's the Mount Washington is actually the highest elevation in the east. And that's where Tuckerman's Ravine is. But the interesting part about this is, so I've been there. It's lovely area and stuff. But I was reading about the fellow that created this. It was created in 1902 or 1900, somewhere around there. The best part about it that I like is, so this fellow by the name of Stickney made it. And so construction started in 1900, opened in 1902. At the opening ceremony, Stickney told the audience, "Look at me, gentlemen, for I am the poor fool who built all this." And then this next line is a little bit disconcerting. Within a year, he was dead at the age of 64. It's like the hotel killed him. And then it actually had to close, and it kind of went through. I also like this part here. They say the hotel was a success, but then the advent of income tax prohibition in the Great Depression curtailed the hospitality business. Goddamn income tax will always ruin everything. And then in 1942, a Boston...
And stop serving liquor would also do that.
Yeah, a Boston syndicate bought the property for $450,000. And then
that's a steal.
The owners were paid. So this Boston syndicate bought it, and then the owners were paid, get this, $300,000 for the loss of business and for hosting the this conference, the Bretton Woods conference. It sounds to me like it was a complete scam.
Thank you for contributing to the conspiracy theories that will now go rampant because they heard it.
Well, if you buy something for $450 and then like a 19-day conference, pays back 3/4 of the value, seems a little bit fishy, does it not?
Yeah, I think it is.
I mean, I read it in Wikipedia, so it must be true.
Your unequivocal source of facts. All right. Anyway, I think that we have to move on. Let's. But Kev, it's time for skin in the game.
Okay. So
I clipped you again, brother.
So you did. Well done. So let's just first of all talk about what the bet was, and then we'll go on to a bunch of things that have happened in terms of updates to skin in the game. So you bet that the 10-year yield would close higher than lower.
I didn't bet. You got to pick,
I got to
my
bet,
friend.
And I chose over. And then I woke up literally on Monday, like Sunday night. The shit hit the fan, and bonds went huge bid, and the yield went straight down.
Okay, so I'm going to draw the line here because it's got to be clear here that while you're trying to say that it was lost right away, we spent in the last 3 days, on Wednesday, Thursday, and today on Friday, with the yield popping its head above our break-even point.
Yeah, but listen, you deserve it. The reality is that we woke up Sunday night. We got going, and it was immediately bid, and it spent. If you looked at the volume traded, Patrick, it's not even close. All the volume traded below it. So you won it fair and square.
And so like,
not only that, as usual, I bet
it's
big.
a stake bet.
It's a stake bet.
It's a stake bet. And by the way, I just needed to show this picture off Twitter of this wonderful, delicious steak, the 1.446 kilogram Wagyu delicious tomahawk steak that I enjoyed at your expense.
Yes.
It was.
So now I got something to say about this.
Okay, go for it.
If that's what losing a stake bet is going to get me, I'm going to lose those all day long. Because that was literally, and I am not shitting anyone about this, was the best steak that I've ever had. And I have, I spent some time on Bay Street. I've gone to a few steak joints in my day. And Patrick, you are an absolutely outstanding cook. And this thing was just pure heaven. And I will, as I say,
I did share it. We did end up doing a tomahawk, which has to be shared. And Lena had her piece in there.
Yeah, well, Lena, you hop on as well. Do you not agree that it was outstanding? He did an absolutely
delicious.
Fantastic job in terms of.
Well, now you have to do this all over again.
I do
at your expense.
But we got to talk about the steak a little more because it was so good. What did you do? You sous vide it, and then
exactly. And then I put like coarse salt and pepper. Very simple. But it's all about the process of getting it to that right temperature.
And then you seared it. And it was outstanding. It was like melting your mouth in the middle with like the crustiness on the each end with the salt. And it was charred. It was delicious. It really.
My mouth is watering right now. I'm gonna go.
I'm not shitting you. Like, it is Patrick, so you kind of your expectations are low. But then you go and you're just like, holy shit, you can actually cook. And this thing was outstanding, and it really was the best steak that I've ever had.
Though we did have an amazing cut of beef to get everything started, right?
Listen, I don't doubt that.
No. Listen, you can't screw up the cooking part, but when you get the right meat, that is like more than half the battle. And then not screwing it up from there is the second half.
It was
right?
absolutely delicious. It was outstanding. And then
let's see if we
you got this
one.
chimichurri or whatever it is that you designed.
The Argentinians.
So Patrick says you got to try this, and I'm like, I don't want that shit on my steak. You're gonna ruin my steak. Like this steak's too good. And then I tried it, and I was like, oh my god,
good.
It's like Patrick's right. And so this was unbelievable. And for anyone that doubts him, he is an outstanding cook or barbecuer at least. And, barbecuing is one of those things that every man thinks they're good at two things, barbecuing and doing something else. And the reality is that most of us suck on all of it. Well, we know what Patrick has chosen for him to be good at. He chose
clearly just one of the two.
That's right, because you can't be good at both. So there's no way. But anyways, I just want to say thank you because I loved it. It really was outstanding. I thought it was one of the greatest evenings. Now, we should talk a little bit about us settling up some of the other parts of the bet.
Yes.
Why don't you get the picture there? Can you grab it?
Oh, my God.
So we can see it while we're doing this. So here we go. You get to see me in my nice COVID extra layer of fat there. That's my pre-hibernation weight there that I'm going with. So I brought a case of beer for Patrick. I was going to bring Labatt Saint-Gant, and I couldn't. They didn't have it in my thing, and I was too lazy to go. So I brought him a real beer. I brought him some Heinekens, and I also owed him a bottle of wine, and it is Patrick. So I found the Coolio dry white box. Now, the thing that I loved the best about this was that when you open it, it says it's good for 6 weeks. So I want to know.
For 4 liters, you need it to be good for 6 weeks.
I want to know what's in there that makes it good.
No, it's because there's no air inside the bag.
No,
right?
I think it's MSG.
Oh my God, there is no way.
There's some preservatives in there.
No,
it's going to preserve your liver.
No.
It's okay.
No,
after you finish
I
drinking.
guarantee you, it's the fact.
And then
that there's
Patrick
no air
got
in the
me a
back.
really nice bottle of Barolo, so I'm going to enjoy that. So the settlements have started to occur.
Yeah, but to add insult to injury, it's like I don't even mind the box wine, but you got me white. I'm a red
I know. Well, I was
going to
get you
rosé, and that was like a punch in the gut.
but friends
Because
don't do
how
that
the
to
hell am I
friends.
going to polish off 4 liters of white?
You have two
when
daughters
all I-
that are that are young
yeah,
adults.
that's true. I'm going to donate to the
For
university
sure.
crowd, and they'll take care of it. I'm sure.
100%.
That's easy
That is
sell.
a university box of wine if there ever was one.
So are you guys going to make another stake bet this week since it seems like whoever loses, I still win?
No, well, we got to know. Listen,
It's like, bet more stakes, bet more stakes.
that's
But
there
we
you
got to
go.
do something different. We can't do the same thing.
No. Well, listen, let's just make a bet, and then we'll see if it feels right for a stake dinner bet.
No, I understand. But I'm
come on,
talking about
it's
this one I've already lost now. So I got to figure it out again. I got to do it again. And I'm thinking that we got to do it.
No, I'm the one who makes the bet.
No, but I lost one today. So I still owe you a stake now.
Right.
So we're going to settle that up eventually. And I'm saying we got to do something different. You can't just do the same. It's never the same.
No,
It's never as good when
we'll
you go
figure it out.
back
Okay,
for twice.
we'll plan it afterwards. Let's
Okay.
get to the fun stuff. Let's actually have a bet.
Okay, so here we go.
All right, so explain the rules.
Okay, Skin in the Game is our weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by next episode, and the currency for the wagers is as follows: a Duke and Duke, a pint of beer, a burger bet, a pitcher, a case of beer, a bottle of wine, i.e. a box, and the big kahuna, the steak dinner. The winner of the bet is obligated to create a new bet for the following week. All wagers settle in full, and there will be no netting of positions.
Okay.
Okay.
I like the rules. Let's stick with these.
So now, so you have a new bet for me because I'm just keep impaling.
Well, you know what?
myself on
I want to keep helping you impale
yeah,
yourself.
I'm
so,
just like I go and I it's minus 30 degrees out, and I see a nice telephone pole to not telephone
lick.
pole to lick, big metal pole, and I rip my tongue off, and then I just go back and
nice
do it the
fence
next
pole.
week.
You do it again.
Yeah.
All right. So here's the bet, buddy. You said I like just working with things you say in the talking charts. You're
you're gonna
suspect
do
of the
my
prairie dog.
my prairie dog.
I'm gonna go with your prairie dog, buddy. And so you know what? The low of today's candle.
Yeah.
Was roughly around what is that, like 43? Let's call it 43.70.
Why did you
All
just
right,
give me straight up or down from here?
No, 43.70, above or below
On the future?
on the settling the September futures contract.
Okay. I'm gonna take below,
what-
but I'm not gonna bet as big as if you just gave me a straight up or down.
No, we're gonna just do 43.70, Lena. You can write that one down. And so you're going below.
Yeah.
Okay. And where
Let's
do you want
just
to
do
start
our
the bet?
pictures. We got to keep getting the pictures because it's looking like we might have the piss up. So we got to
All
get
right.
we got to get the pictures going.
Okay. You know what? I'm going to play it friendly. I'll play you with that pitcher of beer. Sounds good. All right. So let's leave it at that. Let's move on to No Stupid Questions, where we call Lena on to navigate no stupid questions, just stupid answers. So let's where do you want to start with, Lena?
Oh, here's the first question. Dear both, I am a subscriber to both of your paid services and really enjoy your services. This year has been quite successful so far. However, since 6 weeks, I am giving some of my gains back. Hedging through SPY straddle and SPY debit spreads did not help a lot since the S&P 500 has not corrected much due to the FANGs. There comes my question. Since the S&P is so heavily influenced by the FANGs, does the SPY still make sense to hedge risks in the broader markets? Does it make sense to better hedge through an equal weight S&P ETF? Which one would you recommend? Tickers? Or does it make more sense to hedge the Dow Jones or the Russell? If so, what ETFs do you recommend? Can you tell me the tickers?
So
Do you want to do it,
Kev,
Patrick?
I'm just going to start, and I want you to take over.
Okay.
All right. The first thing that you almost always need to do to start your hedging is to look at what you're actually hedging. What's your portfolio consist of? If you are, for instance, heavily weighted into those things that were very much driven by the cyclical trades, heavy on financials and miners and diversified in small caps and things like this, then the S&P is you risk that there's going to be exactly what's happened here, which is that they're going to diverge. And so the more that your basket is not accurately reflecting the actual basket of the S&P 500, the more you might want to explore diversifying your hedges to kind of more accurately reflect your portfolio, including if you have a large amount of mining stocks, then maybe you hedge with the XME, or if you have a large amount of financials, you hedge with the XLF, or you might want to customize your hedging. But whenever you're leaving the S&P, you lose a certain degree of liquidity. Spreads widen, transparency gets a little more trickier. There's all sorts of factors. So what would you say to that?
Well, I would agree completely, and I would say that you have to remember that the S&P 500 is the most used market in terms of those trying to go and access insurance. I think it was Jem that told us that. Jem Carson explained to us that is the warehouser of risk. And with that comes nice tight spreads relative to everything else, but it also comes a function that maybe people overpay for that a little bit because that is where everyone is going to hedge. So that's the first issue, is that you, by choosing the most popular market to hedge in, that you get a situation where you might be overpaying. The other issue is that this was a truly unique situation in that we had those 5 stocks or whatever they are, the big market cap weighted ones, ripping in our face. And in some ways, in hindsight, it could have been obvious that it was, that given that everyone was leaning one way, that you shouldn't go and be hedging in that market, and that you should be hedging, using an IWM instead of an SPX. But you have to remember, at the time, it was looking like that was where those stocks were going to perform better. So I kind of echo Patrick's points that you have to ask yourself what you're trying to accomplish with your hedging, and what you're hoping to do with it. And if you're hedging a portfolio that is filled with all sorts of bets that are more value oriented and more representative of kind of the value trade, you might find that hedging with the S&P 500 is the worst thing you can do, because as we've seen in this last little while, it's the exact opposite has happened.
So Kev, what I want to do highlight is that forget COVID's crash, the 2020 March crash, but once or twice a year come these 10 to 20% market corrections, like the ones here in 2019, like these 10% market corrections that came in the summer of 2020, even the nasty one like the 20% bloodbath or the vol crash that happened in 2018. Once a year, or twice a year sometimes, you get these 10 to 20% corrections that are not bear markets. They're just these mean reverting washout events. Even like look at in the post 2009 period, like once the 2009 lows were in, there was 2 market corrections of the 10 to 20% variety that occurred in 2010, and even the one in 2011. Bottom line is that these types of market corrections happen once a year or so, and you're hedging that. Bottom line, if you were in hedging this little 3-day drop that happened the previous day, this is not what you've been looking to hedge. We have not yet seen one of these style market corrections. And if you were looking for your hedges to kick in and protect you from a market drop that hasn't happened yet, well, of course you're going to be disappointed because it hasn't happened yet. I mean, inevitably we're going to get one of these. There's no way the stock market is going to just go straight up without the rally being checked. At some point, those that are leveraged up and are fully hedged up on when they're vol adjusting and doing all these different things, there's going to be a washout.
Yeah.
And that hasn't happened yet. So the fact that your hedges aren't working, well, the market hasn't dropped yet for the hedges to have kicked in. I know the breadth is deteriorating, but I just think that you shouldn't be upset that your hedges aren't working, because I don't think the market has corrected really yet.
Okay,
anyway,
we'll leave it at that.
All right.
Nina.
Second question. Love the show, you guys are awesome. 3.5 hours may be too much for some podcasts, but it's not nearly enough for you guys.
Well, maybe for Lena, but not for the rest of us. Anyway,
Skin in the Game is a great feature. Since the show is too short, one way to really add value would be to restate the bet, discuss why it was important, and what happened in the market the previous week to determine the winner.
Wait, stop for a second. Why the bet was important? We make shit up for these bets instant on the spot. I don't think that there was anything important about the bet.
Well,
that we
the
made.
only thing that's important is whether I lose a steak or not, or a beers.
Exactly.
And
Right,
actually,
like
the bragging rights of being in the winner or the loser.
Yeah. Exactly. Yeah. Anyway, so go on.
So this is the old rule. Tell him what you're going to tell him, and what you told him. July 16th bet was 10-year yield above or below 1.2, I think, or whatever. Love for you to discuss what happened between July 16th and July 23rd on the 10-year. You guys are awesome. Thanks for all you do. Keep up the great work. Best regards.
Okay, so we did mention this a little bit, but why don't we talk a little bit about why bonds went so bid?
It was really risk off. I personally think that once the stock market had that big downdraft on Monday.
But why did it have the big downdraft?
Well, I honestly think that, we were gamma pinned into the OPEX, and I think that overall the market was pressing new highs, and the rally had to be checked.
You think it was that simple? Because
I
actually think
so.
that it had a lot to do with the Delta variant. For some reason, the market decided...
You've been listening to too much macro voices.
Listen, I never have that problem.
Anyway.
Sorry, I'm laughing too hard. So I think that the market, for whatever reason, chose to freak out Sunday night about the Delta variant. I don't even know why, but it was all of a sudden you got it, and you saw it. You saw Kennedy start to worry about it. There was also it seemed to be that the right-wing community that had previously said that it was not as important and it wasn't going to come, they all of a sudden everyone got together and said, "Oh my God, this is a bigger deal than we thought."
You know what? You want my opinion?
Yeah, sure.
I think that the media has everything to do with that. So when the market is down, they start calling a trading desk and say, why is the market down? And one of these guys goes to the media and says, it's the Delta variant. It must be the Delta variant. So the media goes back, reports that it's the market freaking about the Delta variant, and it gets all over the headlines, and everyone says that that's why it's going down, and I call bullshit. It's just the market was going down, and they needed an excuse, and that's what they said it was. We knew about this Delta variant for the freaking last how many months? This is not new news. This is just an excuse.
Okay, I can't.
That's my variant.
I can't disagree with that, Patrick. I'm not gonna.
That's just my rant.
And
anyway,
then the final thing that I will say is that the whole idea about the hawkish Fed shift, and I know I just talked about how that Powell has made a slight, dovish shift, but originally the whole hawkish shift, which was them saying, yeah, maybe we're closer than we think on the tapering, which caused the whole move in terms of the flattening of the yield curve and eventually caused the risk off. You could just argue that the reason that the bond market kept going down was that it set in motion a monster short covering rally, and that it was just that, as you say, Patrick, it needed to continue going. Some people are still short, and we had more to go.
Right. All right.
Okay.
Let's go on. What's the final one here, Lena?
So the last question. Damn, that cuppy Kool-Aid is easy to drink. I think it's the way he serves it with his ice-cold, sexy frat boy voice. It rolls off the tongue like it's a no-brainer.
It is that sexy frat boy voice.
Is this a male or a female writing in is what I want to know.
Anyway.
Only he or she knows, right?
Yeah.
My account's finally recovered from the last time I drank the cuppy Kool-Aid on shippers. I'm ready to join the party again. How would you go about calculating the risk reward on this trade?
So they didn't tell us which one we were trying to do in terms of calculating the risk reward on Cuppy's trades, but I will tell you this. Cuppy is awesome. He's a lot of fun. He's one of the best traders that I've ever had the privilege of knowing. His sense of market timing, his willingness to go against the grain is impeccable. But his tolerance for risk is out of this world. And I was laughing with him actually this week because I said that, he was giving me some sort of stock and talking about the upside. And I was saying to him, do you ever buy a stock that you think's just going to go up like 20 or 30%? He goes, no, why would I do that? I got things. Like every one of his stocks, he says,
10-bagger.
Yeah, it's like literally his cutoff is 3-bagger. If he doesn't think it's going to 3-bag, he doesn't bother. It's not just dual bag.
Well,
it's
you know what?
3-bag.
But you know what? There's two styles of traders: the ones that go for a probability of success, and then there's the other ones that look for the payoff profile. And if you zero out something that can make it be a 3-bagger or a 5-bagger or a 10-bagger, all you need is to hit like 30-40% of them, and you're still making shitloads of money.
Which
right?
brings me to the point. Cuppy goes and he trades a whole portfolio of these. And so if he has, let's say, 10 positions, and let's say 4 of them are 5-baggers, 2 of them are washes, and then 4 are zeros, which he's done much better than that lately. But let's just imagine that that's what his payoff profile was, which would be even, like in terms of winners, losers, and then, equal winners and losers. He would still make a fortune. Because the ones that hit,
it's like venture capital,
hit in such a big way. So when you're thinking about this and you're trading one of his names, obviously everyone should do their own homework and their own risk tolerance and blah, 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 blah. You know all the disclaimers. But having said that, whenever you're talking to anyone that is an aggressive trader that gives you an idea, you should be aware that their risk tolerance is most likely probably higher than the majority of the people's out there. And you should assign a greater chance that something goes wrong.
Yeah.
And you should position your trades accordingly. And I've compared notes with Cuppy, and it's funny, we have different styles and different ways of doing it. Some positions that he does scares the shit out of me, and then some positions I do scares the shit out of him. In terms of when we talk about different things that we have on, and everyone has their own style. And just the one thing I would say is just be aware that when you're talking to a person that is an aggressive trader that's trading this way, put in a higher probability that something really goes wrong, because he is choosing the crack cocaine of stocks. He's choosing the stocks that are the most down and out with the most leverage, that have the worst balance sheets, because if he's correct, it increases the chances of him having a 10-bagger. But if he's wrong, it increases the chances of him getting zeroed.
Yeah, but at the same time, it's already so down and out that, of course it can be zeroed.
But you should just be aware that he is trading stocks with more zip.
So a lot of my members, which are used to trading using options as a hedge, can calculate risk rewards, or using technical analysis can know where their defined stop losses are. But Cuppy's management of risk is not so definitive in terms of where the loss will be, or where you would cut out, or where you would stop yourself out, because many of these stocks are just not as liquid, and so they need a certain degree of intuitiveness in terms of, as the price is developing, how you manage through it, right?
Yeah, and he's doing his stop loss on a fundamental basis more.
Yeah.
When he sees the story changes, and he's one of the best traders I've ever seen, and just say, nope, I gave up on it. He's not one to stay with the name. If he's like, I gave up on it, it's not working anymore, I have another one that I think is going to go up 3 times.
Bottom line, to answer this member's question, calculating the risk reward on the trade, you don't really do it the way that most conventional traders do. He's more of a value investor, obviously value investor on steroids. But
listen, if I was to suggest to somebody buying some of his names, I would say calculate it like that. There's a chance it goes to 0. And assume that's your total loss, and then size it appropriately from there. Because the reality is that if you get one of his 5 or 10 baggers, you're gonna be happy with it. Of course, you won't have bought enough, but that's just life.
All right, Lena, where can they submit their questions?
So if you have any questions for Kevin and Patrick, submit your questions to nostupidquestions@markethuddle.com.
Okay, thanks for tuning in, folks. We appreciate you spending some time with us. Please give us a follow at The Market Huddle. We're on Twitter every day. Lena's there with her ever-rising Twitter account. What is it now, Lena?
Oh, I stopped counting. I'm just going to wait for a little while and then check it to
That's
crack
good.
again.
I like it. I like it. Once you get into the thousands, you're just like, it doesn't matter. Anyways, you can listen to Macro Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. I am gonna go and read a couple of reviews instead of telling you how we want you to review. First of all, we get a review by Moon Miner. It sounds like a crypto guy. I'm a little nervous about it. But anyways, even though he sounds like a crypto guy, he gave us a good review. He says, amazing stuff, 10 out of 10. However, I recommend everyone new to the podcast to skip the first 2 hours or so of white noise to actually access the quality content. Okay. Is he saying that our guests are, and it's actually us that are called? So I would actually go the other way. I would recommend that people listen to the guests and just once the guest is over, hit stop. Anyways, he says, editing note, Lena, please start cutting those out. Anyways, thank you, Moon Miner. We do appreciate that. And then here's the other one, the Mullet. Great guests, great hosts, truly a labor of love because they have no sponsor. I guess they didn't really fall for it, eh, Patrick?
Yeah.
They didn't realize. They saw through us. Anyways, like the Mullet says, like a mullet, they get the business done up front, and by the end, you were at the tavern wishing the night wouldn't end. I like this one. This is probably one of my favorite reviews lately. It's like Mullet, all business up front, party in the back, which is just like our podcast. It's true. Right? If you think about it, it's like business up front and party in the back. We are the Mullet of podcasts.
That's our new motto. I love it.
The Market Huddle, the Mullet of financial news podcasts. Okay, Patrick, where can they find you?
You can find me on Twitter at Patrick Ceresna, and you can follow me at bigpicturetrading.com. Kev, where can they find you?
I'm on Twitter at Kevin Muir, or you can check out my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market, we're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show. Okay, we got to do this review.
Yeah.
How are you guys feeling?
I liked it. I'm going to start. I liked it. I liked it. You know what? This is, first of all, what I like about this is that I really do enjoy a lot of IPAs, but when I see something with 7 or 8% on it, I immediately, my heart stops. I'm like, Jesus, I'm going to be hammered if I finish like a bunch of these beers. And what I like about this is I got all of the great taste of an IPA at 4.2%, and it doesn't taste like a light beer.
You sound like an old man.
No, but you know what?
You're going to have some prunes with it, too.
Like this, to me, this is the first beer that I want to give a 9, but I'm going to give it an 8.9. But I think
have you never given a 9?
No, I have to some, but the thing is I reserve them for very unique circumstances, unlike two other individuals that rate with me. But this is. But this is
the quality, like at top of the quality of the not outstanding, but not
where I don't want to stick my neck out to give it the 9+. Yep. But this is a great beer. So this is like one step under me saying spectacular thing, but this is a fantastic.
That's a quality review. Portnoy would be proud. That's a pro review, not amateur at all. Lena, what do you got?
I am kind of in the middle of like, I didn't really like it, but I also didn't hate it. So I'm going to give this a 7.3.
Whoa. Okay. That's a little low for Lena.
It's just a little too hoppy for me. IPAs usually get a little.
Yeah, but that's the IPA factor.
So if I was rating IPAs, like on a relative basis for IPAs, this is outstanding. Because this doesn't really taste like an IPA.
It is hoppy like the IPA.
Yeah, it's much better. The fruit I was worried about. Anytime I see fruity and then sessionable crushage or whatever, you just kind of go, oh, it's going to be terrible. It was pretty good though. I enjoyed it. I'm gonna give it better than Lena. I'm gonna give it a 7.7. Because I don't like IPAs. Nice. So that for me, that's a really high IPA score.
Yeah.
Yeah.
All right.
This would taste much better with that steak.
Yeah.
Well, you think so? I enjoyed the wine. Anyway.
Regardless, anything would taste much better with that steak we just had.
There you go.
Just saying.
You know what? I wouldn't have thought like that. I would ask Patrick what we should pair with it because I think he's going to pair something.
I
stupid.
never even thought of the potato chips or something. I don't know, like a nice charcuterie board or something.
Charcuterie.
For this beer, you mean?
No, I was talking about the steak. What wine or whatever.
Steak.
But
Oh, I wouldn't know. Long as
Patrick's
it's
just
not
like, I am only into the food.
Yeah. No, I do enjoy the wine, but I'm not.
Really, I didn't notice.
But I wouldn't know. I don't know how to pair the right wine. No, I don't. I'm not going to pretend. I'm
That's
brutal.
Whatever
right.
it tastes good.
That's right.
Whatever it tastes good.
So listen, let's talk movie. You know what? I just watched.
You watched?
No, I didn't. No, I didn't watch a movie. I watched a trailer for a movie.
Oh.
I watched the trailer. No, but the trailer for the new upcoming release of Dune.
Oh, yes.
Have you guys seen the trailer for that?
I haven't seen the trailer, but I've heard.
Kev, did you watch the original the 1984
So actually,
version of it?
No, I did not. And I didn't read
my
the
God.
book. For some reason, you think that would be right up my alley, and it's not.
You haven't seen the movie?
Okay.
Nope.
So I have a
kind of
confession,
embarrassed.
which might have people like grill me, and that's fine if they do. I, as a younger teen and stuff like that, I actually liked the Dune movie more than Star Wars. Yeah. Back then when I was a kid, I don't know why it resonated with me, but I liked it more. And so then everyone started shitting on Dune and stuff, so I kind of laid low. But I saw the.
Wanted to be
I saw.
cool,
I
so
saw.
I kinda laid
My
low.
opinion was kept to myself.
Patrick has spent 35 years hiding this, and he's just coming out now. You know what? Actually, I like Dune better than Star Wars. Patrick, I'm really proud of you, buddy. I'm really proud that you've come, and that
I've been able to crawl out of the shell.
Use this environment to come
I feel
out.
this is my little safe space. But I watched a trailer and I'm excited.
I saw some
I'm excited.
like, still shots. It looks really cool.
Now listen, the original, is this David Lynch as in the famous David Lynch that did this movie? The 1984?
I'm not
Let me just
I
look
don't
here.
even know.
David Lynch, I think it is.
I'm assuming if it's David Lynch, it is the David Lynch.
Yeah, I didn't realize this. So I haven't seen it. Yeah, that's him. Twin Peaks, David Lynch.
Yeah.
Patrick, I don't know about you. I guess I'll have to go watch it. I'm kind of worried about it though. I just checked. It's 51 tomatoes, which is not.
With the newest
No,
one or
the
the
old
old
one?
Yeah, no, there's people that hacked on it like that, but it did have. You
have to remember, this was
a very
from,
young
what,
Patrick
1984.
Stewart. Sting was back in it back then in the day. Like it had a pretty fun cast. I mean, listen, this is why I'm actually excited about this new version because there was a lot of things that could have been done way better. And the fact that when I'm watching this trailer means they took a second shot at it. And I think I don't want to get my hopes up too much, but I think they're going to nail it. And
Don't lie,
and I'm looking
Patrick.
forward
You're
to it.
just like Timothy Chalamet.
Yeah, I do.
He is pretty dreamy.
Do you like him? He's too girly.
You know what? He's very pretty. I think he's very pretty. And somebody had sent me a YouTube video of various interviews that he's done, but in French because he's fluent in French and in English.
Yeah.
So it's just clips of like a compilation of clips of him just talking in French in interviews.
And it did it for you?
And you're just like, wow,
Okay.
so pretty, so dreamy.
He's like a little boy.
Well, I mean, I don't know how old he is. He's probably like 22 or something.
Lena can now have a toy boy.
Yeah, that's right. That would be.
He's almost too pretty, but
He looks like he weighs like 124 pounds.
probably. It's like half a person.
Although I do kind of.
That's why we were saying a toy boy. Like it's like you can fit him in your suit.
He does seem like kind of. He seems like I shouldn't make fun of him because he does seem like a nice kid. And I saw him on Saturday Night Live, and I didn't realize his mom is like I think she's a ballet or a ballerina or something like that. But
I don't
she
know.
worked on Saturday Night Live as a set designer or a costume or something.
That's cool.
And the funny thing is, she was in a scene like when they needed extras. And then he eventually went back. So listen, he grew up in New York. Like he's a real New York guy. So, like he grew up in the city and
With the French name.
with the French name. Going
What's
with
not to like for girls, right? It's like, oh, he's French
Yeah.
and he's from New York? Come on. Come on.
I think we found something here, Patrick. I think we.
Yeah,
I didn't
am.
expect that because like Lena has shown some appreciation for like weird older dudes too.
I usually do like older men. Like I think older guys. It's like guys are like wine. It's just better when they're aged. But sometimes.
Did we mention Kevin's turning the 5-0 there?
I'm past the 5-0.
Oh, are you?
Yeah.
Damn it! All right.
No.
There you go. Like a fine wine. You've
I'm just like that wine that goes bad and gets corked. Sits there and rots. That's me. You think it might be a fine wine, and then you open it, and you're like, "Oh my god, this thing's corked."
What is that funky smell? Oh my god!
Exactly. That's me.
Yeah, you just need a cooler once in a while, you know?
Okay, well, Patrick, I'm excited for you because you seem very excited about this. So it's
You gotta go watch the original, though.
I think I feel like I should. I should go watch his.
50 to. You know what? No, just wait for the new one.
Just wait for the new one.
Because otherwise you're gonna come back and bust my balls
So
for
you like this one
comparing
better
to
than
Star Wars. Like just.
It was a pretty bold statement saying it was better than Star Wars.
No, I have a right to reserve my opinion. That was how I felt at the time as a kid.
That's fine.
Right? That's where I was.
Yeah, I get it. Listen. I'm not. We like busting your balls, but listen. I finished Letterkenny, and like literally that's the stupidest show on the planet, and nobody did an intervention on me. So
did you crush the whole thing?
Yeah.
Oh my
I
god!
stayed up one night or whatever. Like it's just kind of while I was working and like watching it. And
how long is each episode? Like 20 minutes or something? Okay.
Lena, did you watch one yet?
No, unfortunately I haven't.
Oh.
But
Okay,
I will definitely do it at some
What I was
point.
shocked was I had a whole bunch of people, listeners, reach out to me, and what was interesting was I was expecting them to all be Canadians, and I would say that it's almost like the majority of them aren't Canadians.
You know what? I think I usually, if I see that it's a Canadian movie or a Canadian show, I have a tendency to skip it.
Well, I know I was the same way with like Schitt's Creek. I was like, "That's Canadian. That's gotta suck."
Like, is it gonna make me cringe? Is this? You know
for
what I mean?
sure.
There's something about Canadian TV shows and Canadian movies. That's how it makes me feel. But maybe if you're, an American or if you're from Europe.
No, but
or
do you
wherever,
still
so
feel
you're
that way,
watching
like
it.
about Schitt's Creek or whatever?
Schitt's Creek is funny, but I don't even consider that super Canadian either. Like.
Yeah, listen.
You know what I mean?
They never
Eugene
said anything.
Levy,
You're right.
Dan Levy.
Yeah.
They're not like. Yes, they are Canadians, but
Listen, he went to school. He went to school at like Northern. He's as Canadian as they come.
Yeah, it's just. It's almost too Americanized Canadian show. You know what I mean?
Well, I agree.
But
And
Letterkenny seemed to me like super Canadian, kind of like Trailer Park Boys.
it was like Trailer Park Boys,
right?
Yeah.
So it makes me instinctively, I'll skip it usually. So if you're not Canadian, maybe it's like, ooh, what is this Canadian show? Like that's how I feel about like Australian or British TV shows. I'm like, ooh, what's this show? Let me.
It's like exciting.
Yeah, it's like you watch it
It's
and you're like, oh, what kind of humor
if you
do they
Brit-
have over there?
Well, listen, let's face it. There's a whole bunch of people in this industry that just get by on their British accents sounding good. I know I book guys just because they have a
make
British
pretty good
accent. They
shows.
sound smarter.
It's true. It's
They really do.
true.
They just sound smarter.
They make everything sound so much smarter than it is.
I saw something about it was like a meme that said something to the effect of how America and the rest of the world views Britain, and it's like this fellow doing something very posh and important, and then how it actually is, and then literally it was like during the soccer game, and some guys had pulled down their pants and put like firecrackers, up their ass, and like we're shooting it off or whatever. People are people. They're all the same. People do stupid stuff all the time. And I guess that's in terms of Letterkenny that's what my wife and I are talking about. She says that, hick is hick. So, yeah, it's Canadian hick. And so it seems like it's going to be so unique. But the reality is that there's hicks in Australia. There's hicks in Britain. There's hicks in the U.S. And so it's relatable.
Yeah, I guess so.
Yeah. Anyways, you guys got to watch it.
Okay.
Well, we have our
Anyway.
homework.
You got homework.
There it is. So it was a great steak dinner.
Yeah, so thank you again,
That has
Patrick.
I look
been
forward to
paid,
the next
but
one.
now there's a new one coming.
There
up.
is.
And so Lena, as long as I order a steak big enough, there's always enough for everybody. We're
Listen,
Why-
I honestly,
why is
to me,
that
this was a
2
huge value
kilogram?
because, like, yes, the stupid Japanese cow that you ordered.
Actually, no. This is no. You know what? In full disclosure to our listeners, while the authentic Wagyu is from Japan, this was from an Australian Wagyu. So it's I guess from the same breed of cows, but raised, elsewhere. So I don't know why they get to call it the same thing.
Are we saying it right? Because isn't there a Y in there?
Like a Wagyu?
Wagyu.
I don't know. I don't know if it's Wagyu
it's
or Wagyu.
Wagyu. You know how I
Let's
pronounce
not-
everything wrong.
Yeah, let's not count on
It's
Patrick's pronunciation.
yeah. And so, nonetheless.
Anyways, my point was, even though it was a stupid expensive piece of meat, it was actually cheap compared to going to a restaurant.
Oh.
And
Yeah, when I go to some steakhouses, like $600 to $1,500 bills are like normal.
Yeah.
Right, and so
And-
like.
but why would I do
throwing
that when I got Patrick, excellent chef
All you have
here?
to do is show up.
Like literally, I'm gonna be like, okay, Patrick, let's do this again. I'm happy to lose these things because
Of course, you guys don't freaking touch the vegetables. You guys don't eat anything else. It's like you guys like just devour the meat.
Yeah, you were like, "Do you want potatoes?" I'm like, "No, no potatoes, no sprouts, no."
Yeah, you guys are
nothing,
making me
just
sound like a
meat.
great chef,
you.
except for the part where I freaking scorched the shit out of the
That's
lobster
true.
tails.
So for
Oh.
those who-
The blackened tails.
he did have a little bit of operator error there. He went away, was doing some things, and then I'm out on the deck and I'm looking and I'm like, there's
Hey,
a lot of
long as
fire
the
coming
steak-
out of there, and like
Yeah.
a lot of smoke, and
As long as the steak was not screwed up, then
Yes.
you could get a pass on everything.
I
else,
completely
right?
agree.
Like-
I wasn't going to mention the lobster tails. I was
But
actually.
maybe we should add that to the wagers. Lobster tails.
No, that's like an accessory. That doesn't count.
Well, Luke said he enjoyed them. He was like, "Oh, they were good. They taste kind of like chicken, but they were good."
it's because they were so well done.
They were like flash burnt.
The
Anyway.
Luke was a good. Luke doesn't eat beef, so he's welcome anytime.
Yeah.
I love Lena. She says, just throw on a head of broccoli on the barbecue and we'll feed it to
Good
Luke.
to go.
That was a great line. Poor Luke. Good thing he doesn't listen to this.
Yeah.
Yeah.
Okay. Okay, well,
All right,
anyways,
we'll leave
everyone
it at
have
that.
a great week.
Yeah, absolutely. I'm actually hosting a big poker game right now, so that's why I'm going to wrap things
Okay.
up.
Well, have fun.
I'm going to have about a post-COVID 10 to 12 player big. We'll have 2 tables going. It's going to be a big Texas Hold'em showdown. It's going to be awesome.
Nice. Do you do that often?
Well,
Yeah,
I
'cause
haven't
we
done
were
it
No,
in
obviously.
years
Like
since
I'm talking
COVID thing.
before the.
There was because I was on a hockey team for how long? For a decade, and so the hockey team would always get together. So we'd always have like at least 8 to 12 guys easily show up, and we would drop the cards. So it kind of became a thing.
So do you
But,
play well? Like, are you a good poker player? No.
I have won before.
So I don't.
I have nothing. I certainly am not going to do a victory lap on my poker skills. I mean, you know what's my problem? Is my attention span. I find that I slow play too early, and then once the mid to late game starts happening, the fact that I've been playing, it's like me watching a movie. Why is it that I don't watch 2-3 hour movies? Because I get bored. So after 2-3 hours of poker, I start getting impatient. And then I bet my whole goddamn game on like 1 or 2 stupid hands that I should not have bet on, but I just wanted to stop playing.
I just want to get
please
out.
make this end. So I don't actually play, and the funniest thing is that I have this buddy, and he says you should come play with us. And this fellow is actually a well-known hedge fund manager, and I'm like, okay, so like who's gonna be there? And he starts rattling off all these guys that are well-known on Bay Street, and I'm like, okay, I don't play. I'm not sure that's the best place for me to start. all these like, head traders and all these, hedge fund managers and things like that take this super seriously. And I just think that it's a lot of work to be good at it.
Oh yeah,
like it's like
but
it's
you
like
know,
learning
but it's
trading.
like-
It's a whole other
exactly.
skill that like I don't want to
say,
spend
just
the
the way a
time.
good trader can read the price action and the way order flows coming in and the way the charts are developing. It's the same way reading the table. Like you're not playing your hand. You're playing how everyone
Right.
else is betting, how their tells.
Well, you got to learn all the
you're
math.
reading.
And then you have to
Well,
go to the next level and learn all that
next
part
level.
of it. Like
Oh,
it just seems like
you know what the math is. You know what? You know how many people in our group just there's a game we have where we have a side pot and whoever can win a round playing a 2-7, which is like the worst hand in poker offsuit. And how many people just win hands playing the worst hand? It's because they know how to play the table. I know the math is important, but it's not. Like once you get to the level where everyone knows what they're doing, they can read the play and make the right bets and make everyone else fold.
yeah, I think you still got to know the
listen.
math pretty well though.
No, you got to know the math. You got to know.
Listen.
Poker.
I am by no means a good poker player at all. If anything, I don't even think that I know how to play properly. But bunch of group of friends, when we do play poker, because I am the only Asian person out of that group.
Yeah.
Nobody can read my face. So I may be making, I may just go all in on some shitty hand because I don't know what I'm doing. But they're like, oh shit. And then they'll fold. And then I'll win. So,
Yeah.
some of my friends think that I'm a really good poker
uses her
player.
ethnicity to her advantage.
Because they flat out told me, they're like, I just don't know how to read you. I don't know what's going on in you.
Well, that's an important skill not to have a tell. Like that's the thing.
funny.
When we all know because most of these guys that are coming, we've played together for like a decade, and so everyone knows each other's game. And so
but
you're
the really
literally
good guys are doing that and then pretending.
for sure. But this is
the double
that's the
bluff.
second layer. This is the double bluff. This is like liar's poker, right? Like you're literally playing the bluff of the bluff of the bluff, right? Like it's fun. Anyway, I'm gonna have fun. I'll report back how I
Okay.
did.
Well, we're looking forward.
All right.
Have a great week, everyone.
All right, have a great weekend, everyone. Cheers.